Ladies and gentlemen, good morning. The Global Financial Leaders Investment Summit is about to begin. Please be seated and be kindly reminded to switch your mobile devices to silent mode. Today's summit will mainly be conducted in English, with some sessions in Putonghua. Simultaneous interpretation service is available. You may use the headsets in front of you. Channel 1 is Putonghua. Channel 2 is English. Good morning, ladies and gentlemen. A very warm welcome to the Global Financial Leaders Investment Summit 2024. My name is Teresa Lin from the Hong Kong Monetary Authority, and I'll be your MC for today. Before we begin today's program, can I have your attention and please turn to the entrance to welcome our guest and keynote speaker, the Honorable Vice Premier He Lifeng. 请大家以热烈的掌声欢迎国务院副总理何立峰先生入场。再次欢迎大家 Welcome again, everyone. Every November, we gather here in Hong Kong as a global community to talk about the current state and future of finance. This year has been a year of uncertainties. While we have not yet escaped the many challenges in the recent years, this year of election has brought even greater uncertainties with far-reaching implications for global growth, policy, trade, and the financial markets. Today, we're very honored to have a group of global financial leaders from all around the world to talk about key trends, challenges, and opportunities. We hope today's dialogue will bring to us many inspirations and insights as we sail through these changes. So, ladies and gentlemen, let us begin today's program with welcome remarks from Mr. Eddie Yu, Chief Executive of the Hong Kong Monetary Authority. Eddie, please.
Honorable Vice Premier He Lifeng, Acting Chief Executive, Deputy Secretary General Xu Shouban, Director Zhou Ji, Director Zheng Yinxiong, Minister Li Yunjia, Chairman Wu Qing, Deputy Governor Zhu Hexin, Financial Secretary. Good morning and a very warm welcome to this year's Investment Summit. We feel extremely honored and privileged to host you here in Hong Kong. The theme of the summit is sailing through changes, and people in this room are no strangers to changes. Some changes are disrupting the way that we live and work, like the technological or geopolitical shift. Other changes demand an immediate response, like wild market swings caused by shocks of all kinds. There are numerous lessons to be learned. Stay vigilant, be agile, know where we stand, communicate with stakeholders, so on and so forth. To financial leaders, the question is how to apply these lessons as we steer our organizations forward. From the HKMA's perspective, we focus on two things. One is to build resilience. As a small open economy and international financial center, Hong Kong has built strong buffers that allow us to withstand and respond to external shocks and turbulence. Second is to distinguish signals from noises, to identify trends that are here to stay, and to ride on them with our unique value proposition. To Hong Kong, that means seizing the opportunities offered by a transforming China and capturing the potential unleashed by digitalization and sustainability. Our strategic focus may be different, but our mission is all the same, that we know where we should be heading and how to get there leveraging the forces of change. I trust today's conference will shed light on many of the issues that are occupying your minds and help chart our pathway forward. Please allow me to say a few words in Chinese. 欢迎各位嘉宾出席2024年金融领袖峰会。今年峰会的主题是在变局中前行。我们正面对前所未见的大变局，需要对各种大趋势有深刻、准确的认知，及时调整策略和部署，并以开放的心态保持沟通。我想， 这也正是这个峰会能吸引那么多全球金融领袖的原因。今年我们特别荣幸邀请到中华人民共和国国务院何立峰副总理亲临香港发表主旨演讲，并邀请到监管部门的领导跟我们分享内地的金融发展。我们非常期待今天的交流。我相信在座各位的共同智慧肯定能带领我们在变局中前行。With that, let's open today's summit. Thank you so much.
Thank you very much, Eddie. Next, I would like to welcome Mr. Chan Kwok-ki, Acting Chief Executive of the Hong Kong Special Administrative Region, on stage. Mr. Chan, please.
The Honorable Vice Premier He Lifeng, Deputy Secretary General Xu Shouben, Deputy Director Zhou Ji, Director Zheng Yanxiong, Minister Li Yunze, Chairman Wu Qing, Deputy Governor Zhu Hexin, Commissioner Cui Jianchun, Mr. Eddie Yu, distinguished guests from around the world, ladies and gentlemen, good morning. I'm delighted to welcome you, financial leaders and innovators all, to Hong Kong, where ease meets wealth and tradition marries innovation. I hope you enjoy last night's welcome dinner with its breathtaking view. From that rooftop, on a fine day, you can almost see the future. Of course, there are days and nights when you wish for a little more clarity, for a better understanding of where the future precisely lies. It is much the same these days and nights with the global economy, which is why we are here today, to work together to help see our way to the flourishing future we all want. The global financial landscape has witnessed unprecedented shifts in recent years. Geopolitical tensions, economic uncertainties, and technological change have created a complex environment for policymakers, investors, and companies, large and small, global and local. And if things were not complicated enough, the election results this year across different parts of the world bring lots of new and uncertain dynamics to the international investment picture. For Hong Kong, the upside could mean opportunities for growth in emerging sectors such as fintech and green and sustainable finance. The global push for sustainability is reshaping industries, with green finance and ESG considerations becoming integral to investment strategies. Investors are increasingly seeking opportunities that align with sustainable development goals, driving growth in sustainable infrastructure and green technologies. Green finance is a central policy priority of the Hong Kong government. Initiatives like the launch of Core Climate, our international carbon market, and the government's sustainable bond program have strengthened our green agenda. And the volume of green and sustainable bonds arranged last year in Hong Kong topped the Asian market, accounting for 37% of the total. China's financial development continues to be a cornerstone of global economic growth. With the support of our country, Hong Kong continues to be the world's largest offshore renminbi business hub. As we are working to expand our offerings, providing more diversified renminbi-dominated investment products, increasing the issuance of renminbi bonds, and supporting more green and sustainable offshore renminbi bond issuances in Hong Kong. We will also boost the cross-boundary wealth management Connect scheme and southbound trading under Bond Connect. These and other initiatives will boost Hong Kong's status as the premier gateway for investors looking to enter the mainland markets. Technology is no less central to Hong Kong's future. Artificial intelligence, blockchain, and data analytics are enhancing market efficiencies and driving financial innovation. Hong Kong counts about 1,000 fintech companies and startups making financial services more accessible, efficient, and user-friendly. We are also working with the financial regulators to provide an enabling regulatory environment. In August, the Hong Kong MA launched a sandbox project to test interbank settlements using tokenized money. And our Securities and Futures Commission will develop a regulatory framework on assets tokenization to ensure that the assets are traded in a safe and transparent manner. By capitalizing on this and other emerging trends while navigating their complexities, we are working to build a brighter, more prosperous, and sustainable future for all of us. I know we will make the most of our time here, and while we can only accomplish so much in a few days, I'm confident that the insights and experiences we are sharing, the connections we are making, will lead to collective growth and mutual rewards long down the road. My thanks to each and every one of you for your inspiring presence and invaluable involvement. I wish you all a rewarding summit and the best of business and investment in the coming year. Thank you so much.
Thank you, Mr. Chan. You may now return to your seat. Next, may I invite Mr. Eddie Yu on stage to introduce our keynote speaker. Eddie, please.
A key appeal of our investment summit is that it provides a very unique window to better understand China. China is an important market. It's the world's second largest economy. For years, it's been the single largest contributor to global growth. It has continuously pursued a reform and opening up agenda that benefits not only the Chinese people, but the world at large. Today, we have the privilege of hearing directly from Vice Premier He Lifeng, who plays a pivotal role in China's economic and financial affairs. He is the director of the Office of the Central Financial Commission and the Director General of the Central Financial and Economic Affairs Commission, among his other important roles. And we look forward to his very insightful keynote address. 接下来的主体演讲环节，我们非常荣幸能邀请到中华人民共和国国务院何立峰副总理给我们致辞。有请何副总理。
尊敬的各位嘉宾、女士们、先生们、朋友们，很高兴参加第3届香港国际金融领袖投资峰会。受李强总理的委托，我代表国务院对本届峰会的举办表示热烈的祝贺。习近平主席和中央政府始终十分关心、高度重视香港的发展。习近平主席在2022年7月1日出席庆祝香港回归祖国25周年大会时明确指出，未来5年是香港开创新局面、实现新飞跃的关键期。我们高兴地看到，在中央的大力关心支持下，特区政府有力的带领和香港社会各界共同努力下，香港经济社会发展取得新的成就。今年前3季度，香港的经济同比增长2.6%，已经连续7个季度保持正增长，物价持续保持稳定，就业形势良好，广大香港居民安居乐业，社会安定和谐，欣欣向荣。香港由治及兴，不断迈出新的坚实步伐。从金融领域看，香港金融体系 保持了充沛的活力，对投资者吸引力进一步增强，资本市场运行稳健，离岸人民币市场稳步发展。改革开放以来，香港一直是内地最大的外资来源地和对外投资的目的地，连同内外经济的独特作用进一步发挥，展现出厚重的底蕴和强大的韧性。实践一再证明，有一国两制这样的好的制度保驾护航，有国家鼎力支持和各界的共同努力，香港作为国际金融中心的功能作用必将进一步凸显，国际金融中心的地位将进一步稳固，香港的独特地位和优势一定能够充分彰显，香港也一定能够保持长期的繁荣稳定。女士们、先生们、朋友们，金融是香港的支柱产业和核心竞争力。金融业的发展对于保持香港整体的竞争优势和长期繁荣稳定具有不可或缺的重要作用。从国家层面来看，发挥香港在构建新发展格局和推进高水平对外开放中的战略支点作用，需要强化香港的国际金融中心地位，加快把我国建设成为金融强国，也必然要求把香港建设成为更加强大的国际金融中心。这是金融强国的关键核心要素之一。因此，把香港国际金融中心建设好、巩固好、发展好，既是香港所需，也是国家所重。中央始终从战略全局的高度，对香港国际金融中心发展进行定位和谋划。去年10月召开的中央金融工作会议，对推进香港国际金融中心的建设，专门作出了具体的部署。今年7月召开的中国共产党20届3中全会，对巩固提升香港国际金融中心地位提出了明确要求。国家有关部门按照中央的决策部署，出台了一系列停港、惠港的政策和措施，取得了积极成效。目前正在进一步加力推进各项工作，持续完善支持香港国际金融中心建设的政策体系。我们将更加支持更多的优质企业到香港上市和发行债券，持续优化、拓展内地与香港在股票、债券、理财、利率互换等领域的互联互通。我们将完善国债常态化的发行机制，稳步提升国债在香港的发行规模，支持香港巩固提升全球离岸人民币业务的枢纽地位。我们将支持在香港的中资金融机构进一步扎根香港、深耕香港，更好地促进香港金融的发展。我们将持续推动深化粤港澳大湾区的金融合作，稳步推进粤港澳大湾区内地与港澳相关规则和工作机制的对接，为香港金融发展开辟更广阔的空间。总的原则是，只要是有利于贯彻中央决策部署，有利于推进国家金融改革发展，有利于支持香港国际金融中心建设的政策举措，我们都会积极地深入研究，稳步推进落实落地。女士们、先生们、朋友们，当前世界百年未有之大变局正在加速演进，全球政治经济格局正在深刻调整，不稳定、不确定的因素明显增多。 无论外部风云如何变幻，我们都将始终坚持集中精力办好自己的事情，以自身的确定性应对外部的不确定性，坚定不移地朝着以中国式现代化全面推进强国建设、中华民族复兴伟大事业的宏伟目标勇毅前行。本届峰会以在变局中前行为主题，对于更好的研判形势、汇聚共识、把握机遇、应对挑战，具有积极的意义。希望香港继续紧紧地把握宝贵的发展关键期，准确思辨、科学应变、主动求变，传承发扬狮子山精神，锐意进取，拼搏奋斗，不断地提高金融发展水平，持续巩固提升香港国际金融中心地位。这里我提3点建议：第一，进一步深化金融改革创新，不断提升香港的金融竞争力。百尺竿头更进一步，唯有坚持改革，不断创新，香港历来富有改革创新的精神。我们支持香港通过改革创新，进一步做强银行业，增强资本市场的包容性和吸引力，稳步地扩大债券市场，积极地发展保险市场，丰富离岸人民币金融产品和服务。我们支持香港打造更高水平的国际资产管理中心、财富管理中心，加快发展绿色金融、科技金融、数字金融等新业态，积极发展家族办公室业务，不断培育新的金融增长点，塑造竞争的新优势。希望香港因时因势，不断优化完善金融发展的政策环境，为进一步深化金融改革创新提供强有力的支撑保障。第二，进一步拓展金融开放合作，持续增添香港的金融发展活力。香港是开放型经济体，国际化是香港的鲜明特色和显著的优势。香港拥有高度的自由开放规范的国际一流营商环境，普通法制度与国际接轨，国际联通网络发达。香港金融业正是在开放中不断的发展壮大。我们支持香港继续保持特色，发挥优势，同世界各地开展更广泛、更密切的交流，拓展国际金融合作，积极开拓布局新兴市场，吸引更多国际资本、一流机构和人才来香港展业兴业。我们支持香港立足自身的实际和发展的需要，加强与全球其他国际金融中心的交流互鉴，积极借鉴吸收全球金融改革发展的最新经验和成果，始终走在全球金融发展的前列。第三，进一步对接国家发展战略，着力夯实香港金融发展的根基。香港是国家对外开放的桥梁和纽带，国家是香港金融发展的根基和强大的后盾所在。随着国家高质量发展的扎实推进，香港在国家发展大局中的战略地位作用将更加凸显。我们支持香港积极参与国家扩大制度型开放，以更大力度吸引外资和对外投资，优化区域开放布局等重大改革，并在其中充分发挥独特的作用。我们支持香港进一步做优做强“一带一路”国际投融资平台， 不断地增强在“一带一路”资金融通中的关键节点作用。我们支持香港牢牢把握粤港澳大湾区的发展战略，持续推进金融等领域的规则衔接、机制对接和重点工作部署落地见效，不断地提升粤港澳大湾区建设的质量和发展水平。多年来，香港的金融监管有力有效，金融市场规范有序，金融运行总体平稳。特别是在国家支持下，成功地应对了多轮金融危机和外部冲击的考验，对防范化解重大风险具有丰富的经验和坚实的基础。希望香港继续守护好金融安全。中央将一如既往全力以赴为香港深化金融改革发展、维护金融稳定安全提供充分的支持和保障。女士们、先生们、朋友们，今年以来，中国经济运行总体平稳、稳中有进，高质量发展扎实推进。近期，国家推出了一揽子增量措施，政策的成效在日益显现，经济向好的势头更加巩固，并且惠及香港金融市场。这再次充分证明，中国经济的基本面没有变，经济发展的潜力足，市场广阔等有利条件没有变，经济发展长期向好的大趋势没有变，也不会改变。办好自己的事是完全有基础、有能力、有信心的。面向未来，中国共产党20届3中全会破画了进一步全面深化改革、推进中国式现代化的宏伟蓝图。中国推进改革的决心始终坚定不移，对外开放的大门只会越开越大。随着各项重大改革扎实推进，必将进一步释放中国经济的巨大增长潜力，也必将为全球经济增长持续注入稳定性和新动能。国家好，香港一定好；香港好，国家会更好。希望香港继续发挥背靠祖国、联通世界的独特优势，紧紧抓住国家进一步全面深化改革、推进中国式现代化带来的历史性机遇，深度地对接国家发展战略，在进一步融入国家发展大局、助力国家高质量发展中，更好地实现自身的高质量发展。在新征程上不断谱写“一国两制”实践的精彩华章。我们也热诚地欢迎各界国际友人积极参与香港的改革发展，参与中国改革开放和现代化的建设，共享发展的机遇，共同为世界发展繁荣稳定贡献力量。祝本届香港国际金融领袖投资峰会圆满成功，谢谢。
感谢何副总理精彩的致辞，向我们清楚展述了国家的发展前景，重申中央政府对香港国际金融中心强而有力的支持，我们备受鼓舞。再次感谢何副总理。Now we have wrapped up the session of keynote speeches. We'll take a short break, but please remain seated as Vice Premier He has other official commitments and we have to leave the venue first. Let us put our hands together to thank Vice Premier He again. For those of you who were able to join us last night at the welcome dinner, I hope you had a wonderful time. We also prepared a short video, so let's watch it together. We'll now take a short break. Many participants of the past two investment summits have told us that this event serves as an important window into the mainland market and the latest economic and financial developments there. This year again, we're delighted to have senior representatives from the mainland financial regulators who will share their insights into China's economic and policy landscape in the next session. Please welcome Mr. Eddie Yu, along with our three speakers. Mr. Li Yunze, Minister of the National Financial Regulatory Administration, Mr. Wu Qing, Chairman of the China Securities Regulatory Commission, Mr. Wu Hexing, Deputy Governor of the People's Bank of China and Administrator of the State Administration of Foreign Exchange. Thank you, Eddie.
This session will be conducted in Chinese, so please take on your headset. 中国的经济发展跟金融市场开放呢，一直都是我们国际投资者非常关注的一个议题。当前刚才也提到了，外部的环境非常的复杂，全球经济跟金融市场的不确定性 也不断的增加。同时内地呢也是处于结构调整还有转型升级的过程里面。中国经济怎么去面对各种的挑战，保持稳中有进的高质量增长？内地的推动金融领域的改革开放，又怎么去支持我们的经济发展？又将为国际投资者带来什么样的机遇呢？今天我们非常荣幸能邀请到3位来自中央金融监管机构的领导，跟我们分享他们对中国经济和金融发展的最新的进展，还有他们的政策的部署。首先，国家金融监督管理总局的李云泽局长将会介绍一下内地的金融稳健发展的最新情况，以及国家金监总局支持香港提升巩固我们国际金融中心的一系列的措施。让我们以热烈的掌声欢迎李局长。
尊敬的茂波司长，尊敬的岳文总裁，尊敬的吴清主席、贺新局长，各位嘉宾、女士们、先生们，大家上午好！很高兴参加本次分会。在世界100年未有之大变局加速演进的背景下，本届分会的主题具有很强的现实意义。刚才何立峰副总理高度评价了香港经济社会发展取得的可喜成绩，深刻阐述了香港作为国际金融中心的重要地位和发展前景，充分体现了党中央、国务院对香港的高度重视和殷切希望。正如刚才何立峰副总理所讲，香港巩固和壮大国际金融中心的地位，既是香港所需，也是国家所重。我们将结合金融监管的职能和定位，全力抓好贯彻落实，支持香港的长期繁荣稳定。女士们、先生们、朋友们，近年来，在党中央、国务院的鼎力支持下，在特区政府的悉心指导下，香港金融业充分发挥背靠祖国、联通世界这一得天独厚的优势，主动识变、应变、求变，积极培育发展新动能，国际金融中心的地位持续巩固，超级联系人、超级增值人作用进一步凸显，香港国际金融机构集聚，为内地金融业引进来、走出去发挥了积极作用。全球前100家银行中，有73家在香港设立了机构；前10大保险公司中，有7家在香港开展相关的业务。在港中资银行保险机构总资产中，中资占中资全部海外资产的将近一半。中国内地港资银行的总资产占在华外资银行的近一半。作为世界最大的离岸人民币枢纽，全球约80%的离岸人民币业务通过香港结算。国际投资者对中国内地证券市场的投资70%以上通过香港进入，内地企业境外上市融资80%在港完成。我们相信，随着国家一系列重大政策红利的持续释放，香港将进一步兴旺发达，共享荣光。香港国际金融中心的地位也将焕发历久弥新的生命力，再创辉煌。女士们、先生们、朋友们，香港的命运从来同祖国紧密相连，国家的发展始终是香港的发展的最大依托和支撑。 今年以来，内地经济运行稳中有进、稳中有升，高质量发展扎实推进。尤其是9月下旬以来，随着中央政府加力推出一揽子增量政策，消费、服务业、进出口等主要经济指标明显回升 ，M1和居民贷款增速等金融数据显著改善，各种积极因素不断累积，社会预期持续向好，为实现全年经济社会发展任务目标打下坚实基础。同时，中国内地金融安全稳健运行，为香港金融业稳定发展提供了坚强后盾。目前，中国内地金融业总资产约490万亿人民币，这是截止到今年3季度末的数字。银行业、保险业的规模分列全球第1和第2，运行整体稳健，风险总体可控。银行业拨备和资本的总额约50万亿，保险公司综合偿付能力的充足率是196%，主要的体检指标都处于健康区间，尤其是全国性银行资本充足率近16%，拨备覆盖率超240%，完全能够从容应对各类的风险挑战。金融监管总局成立以来，我们坚持以改革增活力，以发展解难题，以增量盘存量，重点领域风险稳步收敛。首先，有序推进了中小金融机构的改革化险。我们一省一策制定了风险的处置化解方案，重点地区的高风险机构的处置取得了实质性进展。农信社和村镇银行改革稳步实施。第二呢，是有力地促进了房地产市场的平稳健康发展。我们会同住建部建立了城市房地产融资协调机制，突出以城市为主体，以项目为中心，逐步扩大覆盖范围，并陆续出台取消限购、限售以及降低首付比等一系列政策的组合拳，市场信心明显改善。今年10月份，全国新建商品房成交量止跌回升，二手房成交量连续7个月同比增长，房地产开发景气指数连续6个月上升。第三呢，我们是积极支持化解地方政府债务风险。近期出台的新增6万亿地方政府债务限额等一揽子化债政策，将有效缓释地方政府的债务压力。我们指导金融机构按照市场化、法治化的原则，积极开展债务重组、展期、置换，有序压降存量的债务规模，推动地方融资平台转型。我们将坚持系统观念，强化综合施策，持续加大金融供给，优化资源配置，不断提高服务的适配性。在支持经济社会高质量发展中，维护金融体系的安全和稳定。女士们、先生们、朋友们，金融监管总局坚定支持香港巩固、提升国际金融中心地位。在前不久签署的 CEPA 修订协议中，新增了多项金融开放举措，包括取消港澳金融机构投资入股内地保险公司20亿美元的总资产要求，允许港澳银行内地分行从事银行卡业务等。下一步， 金融监管总局将大力支持香港在一国两制的前提下，巩固提升独特的地位和优势，长期保持金融繁荣稳定，在融入国家发展大局的过程中，实现自身更好的发展。一是持续提升金融业对港澳开放水平，尽快完成涉及 CEPA 新开放措施的法规调整，推动相关实例尽早落地，探索推动监管机制和规则相互联通，研究出台提升大湾区金融服务便利化水平的政策措施。二是积极支持香港总部经济建设，鼓励中资银行保险机构在香港设立境外区域总部，支持两地银行保险机构加强全方位协作，为中资企业走出去提供一站式的金融服务。三是助力香港国际风险管理中心建设，支持更多内地保险公司在香港发行巨灾债券，支持香港国际再保险市场加快发展，鼓励在港中资银行参与香港国际黄金交易中心的建设。四是深化两地养老金融合作，推动大湾区跨境养老保险合作，服务香港居民北上养老需求，支持两地保险机构合作开发跨境医疗险产品。五是支持香港培育发展新质生产力，促进两地银行保险机构在绿色低碳、人工智能等新兴领域深度合作，支持香港建设国际创新科技中心。六是携手应对风险挑战，进一步健全两地金融监管的沟通机制，加强应对跨境风险和危机处置的交流合作，完善相关风险的应对安排，全力支持香港金融业安全稳定运行。女士们、先生们、朋友们，党的20届三中全会指出，开放是中国式现代化的鲜明标志。无论国际风云如何变化，中国金融业对外开放的大门只会越开越大。金融监管总局将不断深化金融业的改革开放，着力打造市场化、法治化、国际化的营商环境，支持在华外资机构更加全面、深入地参与中国金融市场，诚挚欢迎来自世界各地的外资金融机构和长期资本来华展业兴业。开放合作是历史的潮流，互利共赢是人心所向。正如本次峰会主题所言，虽有变局，终能扬帆远航。最后，预祝本次峰会取得圆满成功。谢谢大家。
非常感谢李局长的非常精彩的致辞。接下来中国证监会吴庆主席将会介绍我们证监会怎么去落实国9条，一体推进前监管、防风险、促高质量发展的等等的主要的工作进展。吴主席有请。
尊敬的陈茂波司长，于伟文局长，各位国际金融领袖们，大家上午好！非常高兴在这样一个美好的季节，来到这参加这次盛会。北方实际上已经入冬了，但是在香港还是温暖如春，特别是看到了在这么一个地方难得的见到这么多的国际金融界领袖，觉得这屋里的温度也就更高了。 这个峰会啊，我觉得非常受益。实际上全世界各地的金融界都是受益的。这峰会呢也是从无到有，从初创到现在3年走向成熟。这个特别提出了这样一些重要的主题，每年都有非常重要的主题。今年这样一个在变局中前行，我觉得特别好的一个主题，我们共同汇聚在这里。刚才立峰副总理做了重要的讲话，我们云泽同志也做了非常重要的介绍和讲话这些我们都是一致的，我们落实好从何立峰总理的有关的要求。其实云泽同志讲的刚才已经非常清楚了，我这儿从资本市场的角度稍微做一点补充今年以来面对复杂多变的内外部的形势中国证监会贯彻落实中央金融工作会议精神和新国9条。刚才韦文总裁也特别讲了，提示我主要还是要围绕国9条来讲。确实我也是这么想的，但是围绕国9条呢，可能我就要有一个稿子会这样来能够比较完整的来去传递这样一些精神紧扣强监管防风险、促高质量发展的主线，强本强基、严监严管，着力稳市场稳信心稳预期，资本市场企稳回升，也体现出较强的韧性，为经济的高质量发展积极的贡献力量。一是突出支持发展新质生产力发展新质量是推动高质量发展的内在要求和重要的着力点今年以来，先后出台了支持科技的16条，科创板的8条，还有9月份出了并购6条等一系列的相关的政策和制度的安排，进一步增强了资本市场的制度的相关的包容性适应性，来支持优质的资源向新质生产力包括支持绿色发展等等这方面来去进一步的集聚。目前战略新兴产业的 A 股的上市公司的数量接近2700家，全国一共是超过5000家公司里面有2700家是占新产业的。那么今年以来，全市场的并购重组有大概3000起左右。9月份并购6条发布以来，已经有260多家公司披露了资产重组的事项这是指的这5000家上市公司里面有260家披露上市重组事项。特别是在新兴产业里面并购是一个重点。二是突出提升上市公司投资价值投资者是市场之本，上市公司是市场之基。我们督促上市公司牢固树立回报股东意识，提高透明度和经营治理水平，出台上市公司市值管理指引，支持通过分红、回购等方式持续的回报投资者。截止到10月末 ，A 股上市公司已公告中期现金分红就有6441亿元，新增披露回购方案1360单。数量和金额都创了历史新高。三是突出加快推进投资端的改革今年9月，我们会同中央金融办出台了推动中长期资金入市的指导意见着力打通社保、保险、理财等资金入市的这样一些相关的堵点、痛点，建设培育、鼓励长期投资的市场生态当然我们在座的很多也都是有很多的长期投资，当然长期投资、短期投资我们都是欢迎的，但现在这个市场上更需要把一些长期资金入市的一些堵点把它打通。同时，我们稳步推进公募基金行业的费率改革，大力的发展权益类的基金，特别是指数化的投资。权益类的 ETF 的规模今年已经先后突破了2万亿和3万亿元的大关应该说发展势头非常好。 四是突出严监严管，净化市场生态。针对财务造假的顽疾，我们加强部级协调和央地的协同，加快构建综合惩罚体系，开展打击上市公司财务造假专项行动，强化立体化追责。今年前10个月，我们查办的相关案件有658件，罚没款金额有110亿元。同时呢，也充分考虑 A 股市场中小投资者占绝大多数这样一个实际。我们现在市场上有2.3亿的个人投资者。我们将坚持趋利避害，突出公平、规范发展，对股份减持、量化交易、融券等及时完善相关的制度规则和相关的监管的措施，进一步推动3公。5是突出增强各方政策合力，在中央政府的领导下，国家宏观管理部门和金融管理部门近期出台了一系列的大力度的政策利好和政策工具，来稳定投资者信心。我们也会同人民银行快速地推出了证券基金保险公司互换便利和股票回购增持再贷款这样的2项货币政策工具。目前互换便利的首批的500亿元操作已经落地，有超过120家上市公司披露了回购增持再贷款的安排。总的看，在各方的共同努力下，中国资本市场呈现出积极的变化，投资者预期也在明显的改善。A 股、港股和海外中国资产交投都比较活跃。下一步，我们将深入贯彻落实20届3中全会的部署，坚持以改革促发展、促稳定，着力健全投资和融资相协调的资本市场功能，加快形成支持科技创新的多层次市场体系，支持长牵长投的政策体系，抓紧健全增强监管、强监管防风险的制度机制，多举措强化投资者保护时效，不断提升市场的吸引力、竞争力和内在的稳定性。我们相信，随着一系列增量政策举措逐步落地，制度改革的进一步的完善，随着资本市场全面深化改革全扎实的推进，资本市场长期向好的底层逻辑呢将会更加的稳固，也将更好的服务中国式现代化的发展大局。各位来宾、各位朋友、女士们、先生们，习近平主席多次强调，中国对外开放的大门只会越开越大。近年来，中国证监会坚决落实国家关于金融开放的总体安排，积极稳妥推进市场、产品、机构等等的双向开放，有力地促进了资本市场发展和金融稳定。坚持对外开放是中国资本市场走向成熟、高质量发展的必由之路。我们将锚定高水平制度型开放的目标，坚持统筹发展和安全，坚定不移深化资本市场双向开放，进一步便利跨境投资。我们昨天也与香港交易所一起共同庆祝了我们这个沪港通10周年。相信将来对外开放的步伐会越来越大。一是将进一步的保持境外融资渠道的畅通，进一步提升境外上市的备案的效率，积极支持符合条件的境内企业赴境外上市，更好地利用好2个市场2种资源。二是继续拓展与境外市场互联互通，扩大沪深港通标的范围，拓展存多凭证互联互通，吸引全球的中长期资金。三是深化债券市场的对外开放，稳步扩大商品和金融期货市场对外开放，更好地满足投资者国际投资者的多元化的投资选择以及风险管理的需要。四是深入开展证券期货跨境监管与执法的合作，持续加强与国际投资者的常态化的沟通，切实增强政策的稳定性、透明度、可预期性， 不断提升外资机构来华展业的便利度。香港是内地资本市场连接全球的重要的桥梁纽带。中国证监会将以今年4月发布的惠港5条措施作为重要的抓手，持续深化两地的务实的合作，全力支持香港巩固提升国际金融中心的地位，也热忱地欢迎全球投资者都把握机遇，更加积极地投资香港投资内地，更好地分享中国经济的高质量发展的成果。感谢大家。
非常感谢吴主席的非常精彩发言。接下来中国人民银行副行长、国家外汇管理局局长朱和新将会介绍人民银行近期的一揽子的货币政策，以及金融业对外开放和支持香港作为国际金融中心的这个最新进展。我们有请朱行长。
尊敬的陈茂波司长、余伟文总裁，各位嘉宾、各位朋友，来到香港非常高兴，因为见到很多老朋友，也就是新朋友，让我们更加有机会相互交流，相互来推动香港国际金融中心建设。那么刚才我们现场已经聆听了何副总理对中国政府支持香港金融中心建设的一些举措和看法。作为人民银行，作为外汇局，我们理应在这个方面应该发挥更大的作用，来助推香港金融中心建设，这是责无旁贷的，这是我们的使命。那么大家肯定很关切我们人民银行外汇局在货币政策制定，特别是近期一揽子增量政策的措施以及取得的成效，和以及人民银行外汇局如何来推动开放合作，大家也是非常关切的。那么今天当然主题是怎么来关心支持我们香港国际金融中心建设，那我们刚才说责无旁贷的，所以今天和大家做一些分享，做一些交流。那么一揽子的政策，大家已经可能耳熟能详了。那么今天在这个现场，我给大家再报告一下我们的一揽子的政策的相关的举措以及取得的成效。这里边核心的问题就是货币政策，政策和一些具体的政策怎么在落地见效，落地见效，我再跟大家分享一下。一揽子的政策主要体现的是一个降低准备金率和利率，这个大家都已经关注到了，因为这个会带动政策会带动市场基准利率下行。那么9月底以来，下调存款准备金率是0.5个百分点，这个大概释放1万亿左右的长期资金。那么公开市场7天期的逆回购的操作利率是降了0.2个百分点。中期借贷便利利率下降0.3个百分点，那么10月贷款市场报价利率就是 LPR 下行0.25个百分点。这些降准降息的政策进一步减轻了企业融资和居民信贷成本，有利于促进投资和消费。这是一项政策，这是降准降息的。第二项政策是事关房地产的政策。刚才我们银德局长也说了，这房地产大家非常关切。那房地产政策当中主要是体现了4个方面，一个是包括降低存量房贷利率，这个大家也是非常关切的，实际上我们也已经启动做了。统一房贷的最低首付比例，优化保障性住房的再贷款的政策，同时我们也延长了部分即将到期的房地产金融的支持的期限。其中我们作为各位市民老百姓比较关心的就是关于存量房贷利率的调整，这个是中央的一个重大的政策，而且体现了惠民生的一些政策。那么这个效果是平均每年减少家庭支出的利息支出大概1500亿，惠及5000万人，5000万户家庭。我们也注意到，随着相关政策逐步落地见效， 房地产市场已经出现一些积极的变化。因为我们也非常关注这样的一些状况的变化，特别关心市场上近期，比方说看房的这个人群是不是在增加，第二个交易量是不是在增加，也向各位报告一下，看房量的这个数量在上升，交易量也在上升，这说明政策在逐步的得到了显现。那第三个方面当然跟我们吴主席有关的，刚才他已经说了非常关切的关于我们资本市场。那人民银行呢尝试了2项货币政策工具，支持我们资本市场稳定的发展。第一项呢是证券基金保险公司互换便利，那么人民银行委托特定的公开市场一级交易商，以符合条件的证券基金保险公司开展互换交易。这个第一期已经启动了。刚才吴主席说了，500亿已经开始这个实施了，这是一项政策。第二项政策是关于股票回购增持专项贷款、再贷款，激励引导金融机构向符合条件的上市公司和主要股东提供贷款。这个上面也已经实质性的启动，也有了实质性的成效，实质性的。那么这些举措发布后，首先我们信心在增强了。这个实际上在国内市场也好，在香港市场也好，都能体现出来。那么近期股市、债市、汇市等金融市场反应是比较积极的，而且现在也处在一个平稳向好的阶段，平稳向好的阶段。这是大家关切的一揽子的增量措施，大概是体现在这3个方面。那么大家关心的就是金融业对外开放和支持香港金融中心建设这个事，我也想在这里向大家做个报告。党的20届3中全会强调，开放是中国式现代化的鲜明标识，必须坚持对外开放基本国策，建设更高水平开放型新体制。那么人民银行会同相关金融管理部门，持续完善金融领域外商投资准入前国民待遇加负面清单的管理制度，稳步拓展金融市场互联互通，为外资机构来华转业投资创造友好包容的营商环境。这刚才我们银泽局长已经说了，实际上我们还是持有开放欢迎的态度，来欢迎我们境外投资者到我们国内来投资，来共同分享中国经济的发展这样的一个红利。那么作为国际金融中心，香港具备与内地经济发展紧密结合的先天优势，又具有高度开放与海外市场接轨的国际优势，一直是中国金融对外开放的桥头堡。那么多年来，人民银行和外汇局持续深化内地和香港的金融合作，支持香港离岸人民币业务枢纽建设，坚定维护香港国际金融中心地位。这个方面实际上我们跟金管局、跟相关部门一直在沟通，一直在坚持做这样的一个事，支持香港国际金融中心建设。那么有几件事情也在这里向各位报告一下、分享一下。一个是持续深化两地金融市场互联互通，人民银行与香港金融管理部门密切合作，不断优化债券通、跨境理财通、互换通等互联互通的机制。那么在这个基础上，今年我们1月份又推出了3联通3便利的措施，为境内外投资者参与两地市场提供便利，强化香港作为国际资金进出内地的桥梁作用。那目前的状况是什么？是境外投资者持有中国债券已经超过了4万亿了，已经超过4万亿，较债券通开通之前已经增了将近4倍了，这个速度还是非常快的，速度非常快的。而且粤港澳大湾区共有超过12万人个人投资者参与跨境理财通业务试点，直接汇化资金超过900亿。这个也体现香港金融中心建设上、财富管理上它有独特的优势和地位。那么第二个就是积极支持香港离岸人民币市场建设，大家非常关切，这香港是我们最大的离岸中心，人民币离岸中心。那这方面呢，我们人民银行常态化在香港发行人民币央行票据，丰富香港离岸人民币市场的产品和服务。我们也支持香港金管局完善人民币流动性安排。那么在各方的努力下，刚才已经说了，香港已经成为全球最有影响力的离岸人民币业务的枢纽。现在存款将近已经1万亿， 有时已经过万亿了啊，这个市场而且越来越大。那么这个约占全部离岸人民币存款余额的60%了，60%在我们香港，所以它在有可能成为离岸人民币业务的枢纽。第三个是深化合格境外投资者，就是QF 和 RQF 外汇管理的改革。那么今年7月份，我们人民银行外汇局进一步优化对境外机构投资者境内证券期货投资基金的管理。我们优化了登记和汇兑的手续，拓宽了 QF、RQF 外汇风险管理的渠道，推动 QF 和 RQF 以银行间债券市场直接入市等在岸开放渠道的汇兑管理的规则相统一，提升了这个投资者对中国资本市场的便利化的水平。这方面我们这吴前主席也在，我们也希望这个分享我们中国经济的发展，分享我们中国资本市场发展对投资者的这个带来的回报。第四个，稳步发放合格机构投资者就 QD 额度，因为今天我们在座的很多国际机构也在，这个大家非常看重。那么香港金融市场是内地投资者海外投资配置的重要场所，境内投资者通过 QD 方式广泛投资于香港市场的股票、债券、基金和衍生产品。我想在这里也给大家通报一下，现在呢，我们国家外汇局已累计批准近200家机构 QD 投资额度，这个额度已经超过了1600亿美元，200家1600亿美元，那有力的支持了境内投资者这个对海外资产的配置。第5个是推动跨境征信合作，便利企业跨境融资。那么今年2月份，人民银行与香港金管局签署了备忘录，就是要推动内地与香港之间的征信的合作以及这个产品的互认，为两地跨境企业贷款提供征信服务，支持深港两地企业提升跨境融资的可得性和便利性。那么下一步，人民银行外汇局将继续深化内地与香港金融市场互联互通，持续加大金融支持粤港澳大湾区建设，巩固和提升香港离岸人民币业务枢纽和国际金融中心建设。首先是把我们已有的政策要把它用好用实，然后在这个政策的基础上，结合我们香港国际金融的建设，结合这个国际这个金融环境的一些变化，我们还是要进一步在坚持市场化、法治和国际化的这个原则基础上，推动我们金融领域高水平制度性开放，以服务实体经济为导向，不断提升跨境贸易和投融资便利化。同时，因为今天我们各位投资者都在，各位金融领袖都在，我们也欢迎你们再回我们内地看看，和我们广泛的交流。我们愿意在这个方面给大家提供便利，也希望你们来国内投资取得很好的回报。谢谢。
我们非常感谢朱行长的发言，我们的时间已经够了，所以我们再用热烈的掌声感谢我们3位嘉宾，谢谢。
非常感谢几位嘉宾宝贵的分享，请留在台上拍一个合照。感谢。2024 has been an eventful year. Major central banks have pivoted towards easing policies, and elections held this year have impacted more than half the world's population. We've also experienced the hottest summer on record, once again reminding us of the importance and urgency of addressing climate change. All of this with a background of escalating global conflicts. What can we draw from these developments, and how should we navigate this complex landscape? Let's hear from our speakers for the next panel. Let us now welcome our moderator, Arthur Yoon from the HKMA, and our panelists, Jane Fraser from Citi, Colin Keller from UBS, Jean Lemierre from BNP Paribas, and Kanasugu Mike from MUFG. Thank you very much. Arthur, over to you.
Thank you, Teresa. Good morning, everyone. I hope you have heard a lot of very useful information from the first panel. The first panel is about mainland China and Hong Kong. The second panel is more outward-looking. We'll look at the rest of the world. Indeed, the global economy is navigating one of the most complex periods in recent histories. Look everywhere, we have military conflicts in different parts of the world. We have climate crisis that is actually taking shapes in different shapes and forms, depending on where you're looking at. We have all sorts of risks as well, including things like populism rising, potential sort of fragmentation in trade and financial markets, to name just a few. So these trends would have very profound implications for the global financial markets, in particular on all the indicators, future inflation pathways, interest rate glide path, etc. So it's good that we have put together a panel of distinguished speakers to help us to, first of all, tee up the issues and also try to go through some of the possible ways of navigating these very complex trends. So let's go, in the interest of time, let's go straight into discussion. Let me start with Jane. A very quick one. I try to stay not political, but it can't really be not political. Just a very quick one. What's your read of the US election outcome? And what does that mean for the regulatory landscape and deregulation agenda?
Thank you very much, Arthur. It's a great pleasure to be here with everyone. Thank you very much for inviting us all. So the election, I think one of the benefits is we had a decisive result and got immediate clarity. The agenda is largely pro-growth. Some questions around whether it will also be inflationary. And it's one where I think we know what is coming. President Trump's agenda has been clear, and he has a habit of doing what he says he is doing with a few flourishes here and there in the rhetoric. When we think about it, probably 4 T's, if you'll forgive me. Tariffs, taxes, the tapering of regulation, and tightening of inflation. And probably for this room, a couple of observations on 2 of them in particular. When we think about deregulation, the tapering there, we saw an almost immediate unlock happening with the election result. I'm sure when you speak to any of the banks, we saw a huge growth in our pipelines almost overnight in M&A, IPOs. Our sponsor clients are definitely back, and I would call it the big unlock that we've been waiting for a long time. It feels very real right now and is happening. A lot of the system have got very gummed up indeed. Similarly, I think for many clients, the regulation become pretty bureaucratic in industry after industry, and seeing that those getting unleashed, I think puts many CEOs in a good mood, because you need to be very nimble, very agile in this environment. And I think that again is impacting sentiment. And then the other theme is on tariffs, which obviously impacts this part of the world. I'd say that fortunately for here, fundamentals go much deeper than the policies will have an impact. But nonetheless, trade, it won't stop, but it's changing. And that's on top of a lot of the changes that have already happened as global lanes have altered considerably, supply chains, food, energy, technology, financial flows. You know, the last 3 years have seen a huge change in all of these flows. The dampening of some of the trade with potential tariffs will unquestionably accelerate some of the reactions that we've seen from that. I think the big questions off the back of the pro-growth agenda is going to be whether this is inflationary, what that does for rates, particularly at the long end of the curve. The market will probably have a reaction to that. And then I think many of us do worry in the long run about the debt. But as I say, the fundamentals driving the US economy and some of the global economy go deeper than policies, and those fundamental changes will continue.
Yeah, thank you, Jane. You mentioned a lot of factors. If we go into fiscal sustainability, we might have to stay here until 8 o'clock tonight. So let's not stray into that. You talk about tariffs. That's the first T that you mentioned. I happen to know that 25 years ago you wrote a book projecting that in 30 years' time there will be no more geographical barriers to.
If anyone has trouble with jet lag and sleeping at night, I recommend the book. It'll solve it immediately.
But basically what you have projected is that the geographical barrier for businesses would disappear in 30 years. Are we actually seeing exactly the opposite here?
Look, it's easy to say globalization is dead. It's not. It's just changing tremendously. I think we're seeing everyone recognizing we've got to build up resiliency. But the flows around the world are pretty extraordinary. And we're seeing changing lanes, but we're not seeing a reduction in the different flows that are happening. So I think the headline there would be changing, but certainly not dead.
Thank you very much, Jane. When you were talking about the pro-growth agenda making CEOs happy, and I actually saw Sean smiling. So let me now next turn to Sean. Let's cross the Atlantic to look at the situation in Europe for now. So Europe has been facing a different combination of challenges, probably, if I may describe it that way. Relatively slower growth, far-right political movements, energy security concerns, increasing innovation gap with the US, to name just a few. So what's your take? What's your outlook of the European economy and the banking sector in the next few years?
Good to be here. Thank you for the invitation. In a nutshell, all of us around the world, we face challenges, including the US. Listening to your presentation, it could be as if there were no challenge in the US. There are, and Jane was very clear on this, there are challenges. All of us, we have massive challenges. Why? Probably because of COVID, because of monetary policies supporting people at the time of COVID and inflation, because of a successful development of globalization, which has brought a lot to many people, but also creates difficulties and requires adjustments. So all of us, we have these challenges, and this is what we see at the political level. Now, what about Europe? We have challenges we know quite well. One is cost of energy. And it has a lot to do with a war in Europe, which is the war in Ukraine. Cost of energy is a big challenge, which is being addressed. The second one is deepening what we call the single market. We have done this for long. We need to continue to do it. The third challenge would be, in my view, mobilizing in a more efficient way the long-term savings of Europe. May I make a remark on this? Because this is always forgotten. Europe is a continent of savings, and we export savings. Notably, we export a lot of savings to the US. Of course, a question, and that's good. We have no difficulty to do it. Nevertheless, we need to look at how to make a more efficient use of these savings for the benefit of investment in Europe. We have a fourth question, which is competitiveness of the private sector. Of course, this is a question for all of us, but may I remind you here that Europe has very strong and powerful global companies and a very strong network of mid-sized companies, which is one of the main assets of Europe, based on technology, industrial skills, and capacity to invest around the world. To that extent, Europe is probably one of the most open parts of the world, investing everywhere. So when I look at this, I see that Europe is, I was telling one of my friends before coming here that I was going to speak about the roadmap. We have a roadmap. We don't have the 4 T's, but nevertheless, we have a roadmap. And the roadmap is based on fiscal sustainability. There is a framework for discipline in Europe. We like it, we don't like it. Sometimes we don't fully respect their negotiations and discussions, but there is a framework for long-term stability. That's a key point. And Jane made the point the opposite way. That's a discussion we need to have across the world, which is sustainability. Then we have a framework for green sustainability. We are very committed to it, and Europe will stick to it. We need it. We need it for the planet, and we need it because we need to save and produce energy a different way. So when you look at this, and I don't want to be any longer, I think Europe is on a strong footing. There are elections today. There are elections in Germany, there were elections in France, there were elections in the Netherlands, Belgium. We know well the debate. This is part of democracy, this is part of life. But from my client's point of view, I think they have a clear perception of what should be done and what is going to be done. So, yes, we have challenges, like everybody, we have challenges, and this is being addressed step by step based on strong savings, long-term stability and sustainability, and willingness to grow. Now, I will add simply one question. There is an important question for Europe in the next weeks or months, which is war in Ukraine. And the situation of Ukraine, of course, may have a big impact on Europe. Will have. Whatever happens, Ukraine is very important for Europe. It's the door of Europe. It is Europe. So this is a big challenge we have. I hope it is a common challenge.
Yeah, thank you, Sean. You talk about sustainability. Indeed, actually, Jane also raises a similar point about fiscal sustainability in the longer run. We can actually circle back to this issue later on in the discussions. But in the context of Europe, isn't it also true that similar questions could be put to you that I put to Jane? Are we seeing a more fragmented world in terms of both the trade system as well? Are you seeing any fragmentation in terms of financial markets?
Oh, listening to you, I thought you were going to raise a slightly different question. Are we seeing a more fragmented Europe? But you didn't raise that question, so it's easier for me.
Well, you can address the fragmented Europe question as well if you want.
No. You ask the question, I give the answer. No, fragmented world. Of course, there is a risk of a more fragmented world. But we can take this from different perspectives. I'll try to be constructive. We have, step by step, created a unified, is not a more global world, which has brought success and benefits to many people in the world. Nevertheless, Today, we see that the success brings question. And the risk is that the answer to these questions is protectionism and fragmentation. And we have to work on this. This is possible. Let's be clear. Trade is a matter of negotiation. Of course, there's noise, there are threats. That I can understand. This is part of life. But trade should be a negotiation, a discussions. People should sit down, compare notes, and try to find agreements. By the way, this is what's going to be done. The difficulty is not the end result. The end result will be an agreement, because otherwise it would be terrible for each of us, and nobody has an interest in shooting in their own foot. The difficulty is how we get there. And of course, the way we do it can create a lot of noise, perception of difficulties, fragmentation on trade and on finance. And it's a common question for all of us, which is to try to avoid this and sit down and try to make concessions, because all of this is about making constructive compromises, helping people to continue to work and grow. And there are solutions. On trade, it's about tariff, it's about quota, it's about reciprocity, it's about timing. We know the parameters of the discussion. So wisdom should lead to this type of approach, and that would be much better than antagonizing.
Yeah, thank you, Sean. We'll come back to sustainability later, okay? Again, let me turn to this part of the world first before I get back to Com. Miki-san, Japan. Japan has definitely been one of the top interests for the financial world this year for various sorts of reasons. By the way, Hong Kong people like Japan. They travel to Japan over weekends. That's why they also care a lot about where the yen is heading. So can you tell us a bit about the Japanese situation in terms of the asset market? And also probably if you can share with us your perspective on interest rate glide path going forward?
Well, thank you for invitations. I'm very pleased to be here. Well, while, as Jane and John mentioned, we are confronting with the common challenges, but having sit together with the friends from the United States and Europe remind me that Japan economically rather uniquely positioned, as whilst your central banks are making a very effort to how to manage inflation, Bank of Japan has been a struggle for many years to fight against a deflation. Well, Bank of Japan has raised the interest rates for the first time in 17 years in an effort to reverse the deflationary mindset, which persisted for decades long. So that brought the Japanese economy back on a modest growth. That is one of the big reasons why Japan attracted many funds and the capital flows to divide every asset in Japan. So for that point, I would go through just the 2 points. The first one is undervaluations of Japanese assets. What I meant is that the capitalizations of a stock exchange market has been below the level which achieved in the late 80s. It's the first time in this year's July that which surpassed the Nikkei index of 42,000 yen, which is a historical high, but achieved for the 3 decades after. And yet, the PE ratio is around 15 to 60 compared to the 30 times of S&P. So that means the valuation is still low, relatively low. And looking at the other asset class, like a real estate, the total valuations of real estate in Japan has recorded the $17 trillion in late 80s. The current valuations of a real estate in Japan is just $9 trillion, just half of what they achieved at the peak at the late 80s and 90s. So that shows undervaluations of Japanese assets, and also the Japanese yen is weaker right now. The second point is improvement of corporate fundamentals in Japan. The companies listed, which comprises topics indices, recorded the historical high net profits for 3 consecutive years. But that said, well, as I mentioned, PE ratio is still relatively low, and as the initiatives of corporate governance reforms is progressed, Japanese executives become more conscious of shareholders and the capital efficiency. That resulted in the unwinding, massive unwindings of cross shareholdings, and the total annual dividends was doubled over the past 10 years, and also share buybacks was increased by 10 times over 10 years. So that shows how corporate fundamentals of Japan has improved. So that would possibly attract more. And in fact, having been in Hong Kong, I hear from my friends in Hong Kong who says, I'm buying a house in Niseko or in Tokyo. So you already know all these facts. And about that, you asked me about the perspective of Bank of Japan's interest rates policy.
Yeah, interest rate policy.
Okay.
What's your take on the outlook?
Okay. Well, our house view is the Bank of Japan may raise the interest rates once more by the end of fiscal year. I mean, by the March next year, and twice more by March 2026, making the policy rates to a neutral rate. In Japan, that is considered to be a 1%. So there is some people who express a concern that whether the Japanese economy is durable even for that level of interest rates. I would say that that wouldn't be much of a trouble for the Japanese economy, because the corporate sectors, the many corporates are still decreasing their net borrowings, and even SMEs, which is considered to be financially vulnerable to a rate increase, has a multiple 10 times the interest rate coverage ratio, which is the highest in the past 30 years. And the household sectors, on average, deposit of household sectors is the 10 million yen more than they are borrowing. So overall economy is quite durable for the rate increase for that level. Thank you.
You did mention that this is your house views. That's your house views.
Yes.
Do you care to share with us your
my view.
personal view?
Thank you very much. Well, I think our rate increase will be more accelerated because there is a more inflation pressure, especially after the change in the leadership in the many countries. And they put more effort in the economic stimulus. That would put some more pressure on the inflations, and that would impact on the Japanese yen rate, which is still already up to the 150, 155. That is very weak. And the Japan economy are not that export-driven. Therefore, weaker yen would have a negative impact rather on the Japanese economy. So that would possibly, make some change of the mind of the Bank of Japan.
Thank you very much, Miki-san, for your sharing also your personal views on interest rate glide path. Com, let me turn to you. So UBS has always had a very strong presence in Asia. Given all that we've heard, what's happening around the world, a very complex landscape, what's your take on the outlook for the APAC region in terms of growth, in terms of some of the complexity that we're seeing?
Well, first of all, thank you for having me here, and compliments to the Financial Secretary and Eddie for the growth of this conference in its third iteration, which is significantly heftier than it was when it started. And also thank you for asking me a question where I'm not going to upset my good friends Mark Rowan and John Gray. Specifically in wealth management in Asia, we've been here 60 years, and in China we've been here 30 years. APAC represents the largest pro rata growth in billionaires. You're looking at an asset pool of about $3.7 trillion. In up to 2030, you're going to see a wealth generational transfer of almost $6 trillion, and China over time will be a multiple of that. So we see this as an incredibly strong area for what we do best, which is wealth management. But also the interesting thing about the APAC region, unlike the United States, is that the interconnectivity between investment banking and wealth management is very strong, mainly because the number of global family offices, owner proprietors, and so on. So we also have a very strong investment bank in this region, supplementing our wealth management business. Clearly, the demographics are incredibly strong. We have a two-pronged growth strategy for UBS post the Credit Suisse acquisition. Asia is a major fork of that. The other, of course, is our US strategy. Specifically, we brought Iqbal Khan across as president to Asia. He actually runs our global wealth management business, which is underscoring just how important we view this region. So we will continue to invest here. We will continue to grow. We heard today from Chairman Wu and the head of the other regulators and the Vice Premier about the opening up of markets. I think China and Hong Kong are ahead of Europe on its opening up of markets, capital markets access, and should be applauded on that. And they see this as an issue of strategic autonomy. So that actually plays very well into a firm that represents a wealth management business.
Thank you very much for that. But against all those backgrounds of increasingly complex landscape, are there any risks that you think the Asia-Pacific region should particularly watch out for?
Well, you know, one of my mantras is you only worry about what you can control, and I cannot control tariff risk and global thermonuclear war or whatever it might be. So I think in terms of where we are, Asia itself has very good core growth, 4.6%. Even if you look at the tariff effect on China, which will significantly affect Chinese growth, we think China can do quite a lot in terms of remediating that. And also, as we've heard from certain commentators, there has been, and I totally agree with Jane on this, there is no end of globalization, but there has been a strengthening of cross-regional ties, which I think will mitigate some of those effects quite considerably.
Thank you very much. There is another question I want to put to you. It has nothing to do with the complex world, but with complex merger. You have actually had a front row seat of the most complex merger that the financial history has ever seen. So far, so good? Anything that you can share with us?
Let me spend 2 hours on that. Number one, I want to make it very clear that resolution would have worked for Credit Suisse, but it would have been very messy. The theory is that G-SIFI banks do have resolution plans, and can they work? The risk is that resolution, by definition, is contagious and can be a contaminant. So obviously having a private solution is always better for these G-SIFIs should these things happen, and they may happen again. The only note of caution I would give, and we saw this in 2008 with another well-known American bank, if you step in to do the right thing, which in our case was bailing out Credit Suisse and stabilizing the system, what you can't have is post hoc penalties over and above what was agreed at the time. So I think a lesson for global regulators must be, if somebody steps in to do the right thing, that is the right thing, and it should be appropriately rewarded. Secondly, what we found out about Credit Suisse was that this was not an issue of capital. I'm ranting now, Arthur, so you're going to forgive me, right? This was not an issue of capital. Global SIFIs are more than well capitalized enough, and we saw that in March 23. Please, regulators, do not look at yesterday's battle. Look at the issues we need to focus on. Global liquidity framework, access to collateral, and most importantly, what is the role of the regulator in addition to shareholders and the board at looking at the viability of a business model? Having said that little lecture, the integration is going very well. We've actually started doing our technology and client migration in Asia first, and it's working very well. That's what we were most worried about, not the actual rundown of the liabilities and the mark-to-market of what we acquired, but it was actually the integration, and that is well on plan.
I'm pretty sure that, because I run the banking supervisory function in the HKMA, I'm absolutely sure we're looking at the right thing.
No, you are. It wasn't aimed at you.
Yeah, thank you very much. We do have a little bit of time left. I come back to the question of sustainability. I need a brave panelist to answer the questions. Should we be worried about fiscal sustainability, whether it's the US or other parts of the world? Jane?
Yes.
That's it?
If we look at, we've got a decade of building resiliency, be it in defense, be it in the green and the affordability of sustainable green business models and societies, and the list can go on and on. That's a lot of expenditure. So I think the challenge becomes on fiscal deficits. There's a numerator and there's a denominator. The numerator is growth, is helped by that, and then there's obviously the denominator, which is very hard. I think any one of us in the room would say it's easier to spend money than to save money. So I think this is going to be a very challenging time.
Thanks, Jane. Any other comments from the panelists? No. It's fully sustainable or what? Jean, you pick up the mic.
No, but you mean sustainability from which point of view?
Fiscal.
Because for me, sustainability may also mean green.
Yeah. Huh? But let's do a fiscal first.
So I can take the two. No, on sustainability, I've made the point. You know, Europe has a framework for this, to be careful and mindful about the fact that there could be mistakes. Not easy to respect, you know. They are the political difficulties in the two sides. In Europe, some may spend too much money, some may spend not enough money. And we have the debate. That's very well known. But at least there is a framework, and I think it's good to have some limits, some framework about what we need to do. And this is to be monitored very, very carefully. I agree with Jane.
Since you're interested in green sustainability, I have to say that I was in Europe very frequently for Basel Committee meetings, etc. I do sense recently some concerns in Europe about the speed of green or transition or whatever. I can sense that there are momentum sort of waning off a little bit, if I may say so. Do you sense that, Sean?
No, I don't share this view. We have to be specific. I think you are right on perception by people, by the clients, the man in the street. Okay. They think it is new, difficult for them. It requires money and loans, and it takes time. On that I agree. From the business point of view, you have a debate in Europe raised by the car industry. And it has to do with the 2035 year in which normally we should stop selling new thermal engines. So there is a debate about this, which is a debate about the adaptation. Then there is another debate, which is the reporting of what we do, which is very detailed and probably will be reviewed to a certain extent. But if you go to the substance of the question, which is, do we need to invest and prepare to a different world? I think there is no doubt. That's the key point. And when I speak with clients in Europe, all of them are embarked into the story. By the way, quite the same in the US. You know, we have to make a clear view about this. I think the corporate sector has understood it is needed. Because, once more, because of the planet and because of their own needs. And they want to save money and they want to do well. So from a business point of view, with the corporate sector, we do not see any reluctance, on the opposite. But there are, yes, questions on the points I've made, but not on the substance.
Thanks. And any other comments from the other panelists on the green agenda? Nope. We actually saw the next panel lined up over there, so that's a cue for me to wrap up this panel. But let me just wrap it up by asking one very quick question to all the panelists. In the next 12 to 18 months, if I ask you to pick one challenge that we should be worried about, what should that challenge be, and which business line would particularly be impacted? Should we start with Jane again?
The one that keeps me up at night is cyber. I think the combination of fraud, AI, cyber, we're seeing cyber getting democratized. There are multiple different bad actors out there, and you have to get it right every single time to stop it, and they only need to get it right once.
Yeah, thanks. Con?
Well, my immediate concern over the next 18 months is finishing the integration with Credit Suisse. But, and I agree on cyber, and I think AI is a longer-term time frame, but we can argue about that. I do worry about where pockets of risk are building up outside the regulated banking system, and whether you, as regulators, are monitoring that and looking for that. And that's not a criticism or a need for more regulation, it's a monitoring issue. And an example of that would have been what was happening in crypto and how we're managing that risk.
Thanks. Sean?
Not to repeat what was said, I fully agree with what was said. I would mention two. Definitively technology, cyber, but technology, as a whole, it's a key question for all of us. And of course, my second point I monitor very carefully is Ukraine and the Middle East, which may have a big impact on Europe, but a big impact on the world. And the way it is dealt with, agreements around this or not, this is a very painful, difficult situation for the people and for each of us. So Ukraine and the Middle East.
Thank you. Mickey-san?
Well, after three persons mentioned about risk, I was supposed to say something different. That is challenging, I would say. Well, then I would say monetary policy in the various countries is the one we have to really look into. Because in the late 80s or 90s, the developing major countries, central bank decide the monetary policy on their own. So there is a difference in the monetary policy across the countries. Likewise, the 80s, Paul Volcker maintained the very high interest rates. German lowered the interest rates. The recessions following the Gulf War, United States lowered the interest rates, whilst the German raised the interest rates due to the inflation pressure following a reunifications. But since 21st century, entering into the globalization synchronized economic cycle of many countries, and that resulted in the alignment of a monetary policy. This time, as I mentioned earlier on, Bank of Japan is trying to raise the interest rates going forward, whilst the US and the European central banks lower the rates. So this is the first time that monetary policy is divergent between Japan and US and Europe. What kind of the effect that would have on the economy and the financial market is something we have to see.
And also that might have an impact on cross-border fund flow situation as well, right? So thank you very much. We are right on time. Let's put our hands together for the distinguished panels. Thank you very much for generous sharing.
Thank you very much, Arthur, and our distinguished panel. Please stay on stage for a photo. You can go to the middle. Thank you. Thank you. Please remain on stage for our photo for our media on the right. Oh, please. Oh, okay. I guess we'll stay with the official photographer then. Thank you. You can go off the stage, yeah. So we've just heard about the complexities and the risks that we must navigate. What do they mean for business? In this next session, our panelists will share their views on what they see as the most compelling opportunities, the key risks that they anticipate, and the investment themes likely to emerge in the coming months. Let us now invite our moderator, Howard Lee from the HKMA, and our panelists, Jonathan Gray from Blackstone, Ron O'Henley from State Street, Ted Pick from Morgan Stanley, Mark Rowan from Apollo, and David Solomon from Goldman Sachs. Thank you, Howard. Over to you.
Thank you very much, ladies and gentlemen. Now we move to the next panel, which is talking about the market trends and opportunities. Just a little bit of recap. When we enter this year, 2024, many investors expected a pretty roller coaster ride, probably because a lot of things are going to happen at that time. Like almost half of the population will be going through a major election, and the very likely pivot of the major central banks in the year. Now, what it turned out that for investors, it was a pretty robust start of the global markets, and then fueled by very strong growth and excitement around AI, and also it drove a lot of developed market equities to all-time highs. At the same time, U.S. yields rose in the first 6 months, and inflation continued its trajectory towards the 2% target. Now, since then, we have experienced a period of pretty heightened volatility, with the rates market undergoing significant repricing and 3 major central banks cutting rates. Closer to home in Asia, China announced a series of stimulus packages, while Japan initiated its policy normalization. Now the year's biggest political events have mostly taken place, and a soft landing in the US is largely priced in. Perhaps it's time for us to revisit the outlook for the coming year and what are the risks and opportunities lying ahead, both from a macro perspective, and I will try to also touch on a few market structure points going forward. When I listened to the previous panel, I heard Arthur put a question about fiscal deficit, and I thought he had a hard time prompting the panelists to pick up the microphone to talk about this. So perhaps I want to come back to this. This must be a pretty difficult question. And I recall, in fact, Ron, during the Milken conference in May 2024, you mentioned that the US is expected to manage its deficit situation. Otherwise, we might face serious issues in 5 years. With the elections now over and the proposed policy that we have heard, would likely try to increase spending and cut taxes. These are things that might not be very conducive to containing the deficit. So what's your current view on the prospect of achieving a sustainable fiscal path in the US, and what implication do you foresee for the markets and investors? Ron.
Well, that's a big question, and I think what I said was, I don't think I said I expected the U.S. to manage the debt situation, but I thought it was imperative that it start thinking about it. I mean, listen, debt levels in the U.S. are at an astounding level. I think we all know that. And if you think about the fiscal and economic situation that we've been through, these levels of debt make no sense, given the kind of growth and the economic prosperity that the U.S. has had. 99% of GDP, probably approaching something around 125% of GDP within 10 years. And at the same time, this has happened when interest rates are going up, right? So the cost of debt and the cost of servicing the debt is likely to double over the next 25 years. What was astounding, it's even more astounding to me, though, is if you think about all the words that were spoken in this last election, does anybody recall anybody saying anything about debt? I don't think anybody did. And so if you looked at the word cloud for debt, you saw the white space, that was debt, because it was never spoken. So this is a real challenge. And the trouble for politicians is, in US politicians, is the US has this incredible position as the reserve currency. So this is one of those problems that's not apparent and can easily be kicked down the road, but we just don't know how long this can last. What we do know is these numbers have never been seen before. And what we do know is that at some point, but we just don't know when, the holders of the debt are going to react. And they're going to put a premium on this. And if you think about the breadth of the Treasury market, how important it is to virtually everybody in this room, and what it would mean if you started to get wobbles in that market, what it would mean for financial markets beyond that. So I don't think this is a problem that can be that we can wait until it manifests itself, because if it manifests itself with the kind of privileged position the US has, I think we're in real trouble. So to me, it is time for somebody to come forward. I did think if I were advising Kamala Harris, I would have said, you should talk about this, because nobody would have expected a Democrat to talk about it, but she's not the president. President Trump will be coming in, and I think at some point it is important that he address this. And how we do that is the bigger problem. We've been down this road before. Simpson Bowles was actually a pretty good effort, and we got right to the finish line there and then did nothing. But it's very, very hard to imagine that the kind of spending that we're talking about and the kind of tax path that we're on is actually going to enable us to get to a point where we can have and maintain sustainable debt levels.
Yeah, well, that's a very good analysis, but I just want to put to you or any panelists that at which point do you think investor would start to get nervous about this and ask more and more questions about this? Ron?
I mean, I'll start, but there's plenty of people here that can add. I mean, I think any kind of a failed auction or an auction in which we didn't see the take-up in treasuries that we thought, it doesn't take a lot. I mean, think back to COVID, think back to the financial crisis, what it was that was starting to rattle these markets. So I don't think it would take much to do that. But I mean, the challenge now is everybody believes there's plenty of solutions, right? If things get really bad, the central bank can go back to quantitative easing and just continue to buy up debt. But what we don't know, because it's uncharted territory, is how long this can last.
I see. So David and Ted, do you receive more inquiries about this from your clients?
I certainly think in the investment community, in the professional investment community, there's a lot of focus on this issue. I agree with what Ron said, that the preeminence of the US dollar gives the United States enormous runway and latitude to be very patient about how this is managed. But ultimately, you know, there are only a handful of ways out of this, especially if we continue on the same fiscal path. And so, you know, you can run a more aggressive growth strategy, and if you run a more aggressive growth strategy, that can compensate. I think people are watching this. I don't think we're at a place where there are alarm bells, but I do think we've grown the debt stack in the United States very significantly. We've kind of grown it 4.5 times in the last 15 years. Just refinancing the current stack at today's levels continues to grow it through the rest of this decade. I think we've got a lot of latitude given the preeminence of the US dollar. But at some point in time, there'll be some event that creates more focus around this if we don't create a growth strategy that allows the current trajectory that we're on to rebalance in some way, both a growth and spending strategy to allow it to rebalance.
Okay, very good. And for a reason, you know, I'm not putting this question to Mark, but if you volunteer to answer it, I don't mind.
I was so happy to see Ron on the hot seat here.
Okay, perhaps I turn to Ted for a question that's slightly different, but a related question. And I look at my record, and I find out that you say a couple of times that we are seeing the end of financial repression. Now, when you said that, what was the most important market shift that you had in mind when you keep mentioning this? And now, with the general expectation about the U.S. fiscal situation, very little political appetite to really contain the deficit. And on the other hand, a few inflationary factors seem to be coming up and going in force, like supply chain rewiring, climate transition, and higher military spending, and aging population. Now, are you worried that some form of financial repression would be creeping back in? with inflation moving up faster than short-term rates, and how should firms like Morgan Stanley position themselves for such changes?
I think that was Ron who said that. Well, we had 15 years of zero rates and zero inflation, and something was going to happen eventually to take us off of that. And that event, of course, was the pandemic, 5 years next spring, and then the remediation and the stimulus, and then, of course, the unleashing of populism that came on the back of that. And you're right that there are ongoing inflationary themes that bear consideration. Some element of deglobalization, ongoing climate transition, the muscularity of the nation state or regional alliances, i.e. defense, war, those are all inflationary. And it is also the case that there are 3-4 years of a cohort in the US that never actually received the stimulus but received the inflation. And then there are others still who drew down on their stimulus and are not asset owners, and so they need to be minded as well. So in a sense, there is an inflationary backdrop, and there is now the additional complication of the potential for tariffs, and actually net emigration also would be inflationary. But we have to put that against the reality that the consumer and corporate community, by and large, is in very good shape. The economy continues to grow, and that is a good thing. And the reality is that the bond vigilantes are out there, and they will be looking at the long end, but we should bear in mind that the long-term Fed funds rate for the last 80 years or so is about 4%, and it would not be unreasonable to think that terminal rate could be 3 to 4%. So the Fed might well be bearing that in mind as something that is normalized. I think when you put all of that together, the hot and the cold, there's enough there to conclude that the idea of going back to financial repression, if that means 0 and 0, is highly unlikely. What is that terminal rate? We'll see, but if we continue to grow, 3 to 4% is not a bad place to be. And for the Fed to move prudently, given that there will be hot and cold prints, is a smart thing to do. With respect to our business models, we raise, manage, and allocate capital, and this environment has been one where if you are in the business of allocating capital, it's been great for our markets businesses. A normalized economic environment with some level of uncertainty and some level of cost of capital, that's great for allocators. And then if you're managing capital, cash, for example, you saw that there's $7 trillion now in U.S. money markets. Cash is a strategic asset at 4.5% or 5%. So the managing capital business in our wealth and investment management business is good. And what we're most excited about as a group is the idea that we're going to get into raising capital mode. That is the last piece of what is the hallmark of a growing and thriving economy, which is where the classic underwriting and mergers and acquisitions businesses take hold. So if you think about that against the big picture, I think financial repression is behind us, and we'll have more normalized economic conditions. And yes, the bond market is a daily check on hygiene at the sovereign level, and we'll all be watching that. But for now, it looks like a growth plan is starting to take hold, and we should, on balance, be bullish about it.
Yeah, well, thank you very much, Ted. Now, I now turn to David. Given the macro backdrop that we just talked about, what are you seeing by ways of financial market activity in the U.S. and perhaps other regions, in particular in Asia?
Financial market activity in terms of capital raising activity, or?
Yeah.
Yeah, so the capital raising activity in the U.S. and around the world has been muted. You know, we had an extraordinary dislocation coming out of the pandemic, and with a massive amount of fiscal stimulus, we basically took capital raising activity, market activity, to kind of peak levels in 2020 and 2021. And then with the war in Ukraine and a reset with inflation and a reset of values, we slowed that all down. And so for the last couple of years, if you look at M&A activity, if you look at equity capital markets activity, we've run meaningfully below 10-year averages. M&A activity this year has run a little less than 15% below 10-year averages. I do think there's been a regulatory overlay to that because the FTC in the United States has had an implication on those activity levels. And I think equity capital raising activity has run about 24% below 10-year averages. Debt capital markets activity this year picked up meaningfully and has run above 10-year averages. And given where we are at the moment, Spot, you're starting to unleash some of those animal spirits, and you're seeing a pickup in equity activity, pickup in M&A activity. I would say with the new administration, we'll have a different FTC. You know, all of that, I think, in 2025 should contribute to more robust levels of both capital raising and M&A, which is obviously good for the ecosystem that everyone here sits in.
Yeah. Okay. And now I would like to stay on with David, but having talked about the macro thing, I would like to move on to a little bit to talk about like what I foreshadowed at the beginning, a structural market shift. Now, as non-bank financial firms like Jane Street and Citadel Securities are emerging, and significant challenges to traditional investment banks in market making. They are taking a very, very big share of the business and growing fast. How do you see this shift affecting the competitive landscape for firms like Goldman Sachs? And perhaps Ted would like to supplement as well from Morgan Stanley's perspective.
Sure. You know, all of us on this stage have been in these businesses for a long time. Just start by saying these are super competitive businesses. They've always been super competitive businesses, and they will continue to be very competitive businesses. You mentioned Citadel and Jane Street. They have interesting businesses. You know, I'd say their focus, particularly in equity markets, on what we call anonymized flow, and the technology they've put behind that has allowed them to have very significant market share in those areas. There are certain regulatory arbitrages that exist that have allowed them to invest in game focus there. But at the same point, those are narrow aspects of the overall ecosystem that firms like Goldman Sachs and Morgan Stanley participate in. That would be interesting. Goldman Stanley, a little bit of a merger there.
I was thinking Morgan Sachs.
Wouldn't surprise you, I was thinking of Goldman Stanley. But firms like ours run very, very big, complex ecosystems where we bring, you know, a wealth of products and services that are necessary for big institutions. And, you know, I think and I look at our focus on our clients, our ability to finance our clients, our global reach, our scale. We've had significant market share gains. I think we've taken our market share in those market activities up by about 350 basis points over the last 5 years. You know, these large platforms are very capable of competing and will continue to compete. So there'll always be competition. There's always change. Technology advances change. But I feel, you know, really strongly about the value proposition that a big global organization like Goldman Sachs can provide our clients.
Yeah, I totally agree with that. Scale and global, you have to be. To run an equities business, there are three of us that have about, 60% of the top line. Just to run that business costs $4 or $5 billion a year, even before you turn the lights on. So you need global scale. And then when you look at emerging pockets like private credit, there's plenty of room for us to interact. The relationships may get more complicated at times, but our ability to source, structure, finance, manage that capital is profitable. And again, if you have the right kind of scale and resourcing, you can do it successfully.
Yeah, well, I heard you mention private credit, so this is something that I would like to touch on as well. Of course, when we talk about private credit, everybody thinks about sort of Mark and Apollo. Now, we heard a lot of these suggestions that private credit managers are really taking the lunch of traditional banks as well, and with the booming private credit market and regulators around the world, many of them also are concerned whether this is going to cause a systemic risk to the financial system with the growth of private credits being less regulated, less transparent as compared to banks lending. So, I wanted to see your take on this, and also for Apollo, while people say that you are taking the lunch from banks, you are having some collaboration with certain banks like Citi and BNP Paribas. So do you see them as friends or frenemy, or so? What's your take?
So First, I consider the bankers to be very smart. So it's not just 2 banks, it's actually 12 banks. And it'll be 15 banks by the end of the year, including partnerships with many of the people here. And so we have found commonality of interest. And what's been interesting to me is the discussion with global regulators, because I think that's actually a more interesting way to come at it. We all grew up in an environment. I look at the kind of experience level in the room rather than saying age. The experience level in the room. And we grew up with an innate belief. We think private is risky and public is safe. We know in our bones that's true. And 40 years ago, which is how long ago I started, it was true. Private was 3 products: venture capital, private equity, and hedge funds. All risky, but also all in the right way, used perfectly. And public was 8,000 public companies, diversified portfolios of stocks and bonds. But what if our belief that private and risky and public is safe is just wrong? Then everything we've done in asset management for the past 40 years probably needs to be revisited. Because when something's risky, you stick it in a little bucket. You call it alternative. You watch it carefully. You want really high rates of return. But if private is safe and risky and public is safe and risky, why do we think they're any different? And the answer is it's just change, and regulators are being forced to actually address this right now. So in the US raises 50% of the world's capital. It has the most diversified funding markets. We have public markets, we have private markets, we have bank markets, et cetera, et cetera. Everywhere else in the world is pretty much limited from a capital raising flow. Europe is being forced to confront this in a major way. The Draghi report points out some of the more obvious holes in the market. And we find ourselves in an interesting dialogue now with particularly European regulators. How did they start a private market? How did they get private investors off the sidelines? And the intersection of what we do with the banking community is going to find its own level. Banks are amazingly good at some things. In asset managers, particularly long-dated asset managers like ours, good at certain things. We found our accommodation with the banking system. I think it is the regulatory landscape and the public's view and the participants' view of public and private that needs some updating. And some of the things we're doing, particularly with Ron, actually are going to call the question. I think 18 months from now, investors broadly will not actually talk about public credit and private credit. They're going to talk about credit. They're going to talk about whether something's investment grade or below investment grade. I actually don't think we're going to know the difference between public and private in 18 months.
18 months, so maybe you're right. But the fact that people keep asking this question means perhaps we need more information, more education, or whatever. So because lack of transparency or less transparency or more opacity naturally means that regulators or officials feel a little bit uneasy. So is it something that we can do more to sort of make everybody a little bit comfortable with that?
Well, I would say the following. If most places I go when I speak with regulators, almost everyone grew up as a bank regulator. Their knowledge base is as a bank regulator. Their information sources are as a bank regulator. From an investor's point of view, from a public markets point of view, banks disclose 2 lines: loans to customers, loans to companies. You click on John's website, my website, you get every holding every quarter. And so we start with a set of assumptions that private means less transparent that are just false. It's just the information is located in a different place. And so I put it back almost as a question the other way. What is the actual difference between public and private? It's not the size of issue. It's not the issuer. It's not the rating. It's not the provision of financial information. It will not be the trading and the price transparency, because new news, there is no trading in fixed income, public or private. We have the illusion of price. We don't actually have price. And what's happening is all of the tools that exist in the public market as it relates to fixed income are coming to the private market. And I think very quickly investors are going to be confronted with the fact that what's different is something in their mind rather than something that's real.
Howard, I just want to pick up on the first part of your question where you said that the bank regulators are concerned about the rise of this phenomenon. I would argue that the bank regulators have gotten exactly what they wanted here. Coming out of 2008, there was this view that banks were enormous concentrators of risk. And we saw what happened with the bank failures. And what they've done through various re-regulation capital rules is they've taken a lot of that risk out of the banks. They've basically unenabled banks to lend as much as they can. And what you've got now in private credit is actually a distribution of risk. It is not concentrated in institutions. It's not to say that there are new risks arising, but bank regulators have gotten exactly what they wanted in terms of less concentration of risk in banks and distribution of that risk more broadly.
Okay, thank you very much. That's very helpful. Now, I'm now turning to John. Of course, you have your credit strategy, but I'm not going to ask you about credit. Of course, ask you about commercial real estate. That's another sexy subject. Now, I remember that you talk about the headwind at the summit last year for the real estate sector. And we also had another fireside chat, I remember very clearly. You told me that we can fall in love with everyone, we can fall in love with everything, but don't fall in love with our investments, including our real estate investment. So we need to cut it when we need to. But in recent months, you reiterated that investors should invest before signs are all clear. So you really think that it's time to really mend relations with our old love here?
Yes, I think you should rekindle your love with real estate. And I would say going back in January, we said publicly we thought real estate was bottoming. We've invested now, over the last 12 months, $30 billion in the space, which is a reflection of our very high conviction here. And the question is why? And I'd say first it starts with underlying fundamentals in real estate are pretty good. In most of the sectors, in logistics and rental housing, where we focused our investing, vacancy rates are 5%. Cash flows have continued to grow, even through this difficult period, albeit at a slower rate. Now, the office sector, as we know, post-COVID, has had a lot of challenges. But the rest of the commercial real estate market has generally held up. What hit the market was a sharp increase in cost of capital. Base rates went up, spreads widened a ton, cap rates or unleveraged yields on real estate went up, and that caused the decline in value. And if you look back about a year ago, things sort of reached their peak in terms of negativity in real estate. And since that time, we've seen total borrowing costs probably drop 35% or more. We have seen the commercial mortgage-backed securities market reopen. It's up fourfold over where it was a year ago. Transaction activity's picking up. There are 2 or 3 times more bidders showing up at auctions. That's obviously positive. And then longer term, real estate's about supply and demand. And you've seen new construction and things like warehouses decline, new starts decline 80%. And that creates a foundation for the ultimate recovery. So I think for investors, it's hard because there's still a lot of bad news in the system. They've taken losses, and they tend to want to wait for that all-clear sign. But if you went back to the financial crisis, you wanted to start investing in real estate in 2009. If you went back to the early 90s, 92, those couple of years coming out were when you saw the best returns, where you're still feeling a little more uncertain. And I would say today we're in a similar period of time, so we choose to lean in.
Right. So do you see different pockets or different verticals in the kind of a real estate sector that you would particularly like or less like?
Well, as I said, you know, the fundamentals and logistics driven by the move to e-commerce have continued to be strong. We like that on a global basis. We're the largest investor. Rental housing, since the financial crisis, we have had a real shortage of building. It's one of the issues in most of these developed market elections is the shortage of housing and the cost of housing. And that, of course, has translated into pretty good rental growth. And I think coming out of this, again, new construction's come down, so we still like that space. The hotel business, again, people are going to travel. We've seen less construction there, so we're bullish. And then in the office sector, I think you've got to be a little more selective, given the capital needs and the underlying vacancy, but maybe buying some of the best buildings at favorable prices, maybe through debt, that could be attractive. So I'd say we generally see the landscape is pretty good at this moment. And of course, in 2 or 3 years, it'll be less good after you've had a number of good years of returns and more capital will pour in.
Well, I drew on this one more point and then open up to see whether other panelists has other view as well. Is you didn't mention AI's kind of a data center. You are sort of putting big money into this data center, but now it's an AI craze and then everybody putting a lot of money in it. But some people say that, oh, the monetization model is still pretty unclear. So do you think this is too much money into it? Is it a bubble going on?
Yeah, I should have mentioned data centers. That is our biggest theme across the entire firm. It's really the physical manifestation of the digitalization of our lives. If you think about data storage, if you think about cloud migration, and of course AI, it happens at the data center. That is where those GPUs sit and communicate with one another, and the needs for compute power are enormous. And so we have gone out and now have $70 billion of leased data centers, a pipeline of another potential $100 billion we could build. We're doing it in the US, in Europe, in Asia. We're doing it in equity. We're doing it financing. We continue to be quite bullish. I think the real question is this like the railroads in the 1880s in the United States where there's a great underlying trend of demand, but it's going to be swamped by new supply, which kills the returns? And I'd say in that regard, there are two protections. One, you don't go out and speculatively build a data center like condos in Miami, because there are only 4 or 5 tenants leasing, and the cost of these centers is quite extensive, and you have to customize in many cases. So it's $1 billion. So we're not seeing the kind of speculative building that kills returns. The second thing is that we've got a global shortage of power, and that is going to become more and more acute as we electrify everything. First with these digital assistants and AI, and over time with robotics. And when you go out today to build a data center, in many places you can't. And so if you're a developer, you have the know-how, the zoning, and of course the access to power, you're in a unique spot. So this is a space we like a lot, and we will continue to be all in as it relates to digital infrastructure and data centers.
Yeah. Yes, Mark, you have anything to add on this topic? And
look, I think John certainly has identified the trend, but I'll simplify. For us, data centers is one real source of demand. Energy. In the US, we're talking about energy transition, but we're now talking about energy accretion. We're going to build lots of power. We're building infrastructure. There is so much demand for capital. I think of this in terms of debt and equity. There are just so many underlying drivers. In some of the markets, I think you want to be debt. You're concerned about overbuilding. You're concerned about pricing. You're concerned about tenancy. In other of the markets, I think you want to be equity. I think what we're watching is what I'll call this, global renaissance or industrial renaissance that is taking place. And the factors are not just the newfangled data centers. What's going on is nothing short of extraordinary. I mean, people forget the last 3 years in a row, the US has been the largest recipient of FDI. It likely will be again this year. Massive amount of building. 3 years ago in the US, we allocated money for infrastructure, all under construction. 2 years ago, $52 billion of semiconductor subsidies. Not a single plant open yet, all under construction. A year ago, Inflation Reduction Act, $1.3 trillion, everything under construction. Defense ramping up. And so what we're watching is just this incredible demand for capital happening against a backdrop of a US government that is running significant deficits. And so the capital raising business, I think that's going to be a good business.
Okay, that sounds very good to iBanks and now time is running out, so I would like to put my last question to Goldman Stanley and
Goldman Stanley.
Yeah. Now, talking about Asia, and we saw a round of stimulus announced by the mainland authorities in September, and we saw very strong rebounds in the equities market in mainland China, but subsequently it's tamed down a little bit. Today, we heard some positive remarks from the Vice Premier, and we heard the statements by the main regulators in mainland China. So do you think investor would feel more assured, or if not, then what do you think investor would like to hear more from the mainland authorities before they regain a stronger confidence in Chinese assets? Maybe David, you go first.
Sure. You know, I think you've got a combination of issues that have global investors, you know, predominantly on the sidelines with respect to capital deployment, you know, foreign direct investment into China. And if you're looking for, you know, messages that can assist, you know, certainly some of the messages today are helpful about the continued opening up and the continued, you know, transition. But when I listen to global investors, one of the things they continue to be concerned about is they've put a lot of capital in, and it's been very difficult over the course of the last 5 years to get capital out. And so in that context, I think messages around the ability to both attract capital and have capital come in and come out are very, very important for global investors. And I think also the context of more confidence in the stability of the economy. There are a lot of things that are going well in the economy, but seeing improvement in consumption, you know, the stimulus was a first step, but seeing improvement in consumption in the economy, I think, is going to be very important to win back some of the confidence of the broad national investing community.
Thank you. Ted?
Yeah, I agree with that. Transparency is important, and battling deflation takes time. And so the monetary impulse is starting to take hold. Lower interest rates, more attractive mortgage rates, inducements to new ownership. The fiscal piece will take time. The real estate dynamic is going to take a number of quarters, and clearly there's focus on that. We should bear in mind, too, that 30% of disposable income is held in savings, average household in China. So that is a very strong number, and clearly the name of the game here is to reignite consumer confidence. And that's something that takes a while to take hold, but we're seeing some green shoots.
Can I mention one other thing I wanted to mention? Capital markets are hugely important. And, you know, continued progress in the opening up of the capital markets is hugely important. It's a huge advantage for the United States. The more you can broaden capital markets, the better in terms of ultimately that cycle of capital deployment and capital investment.
Second largest economy, second largest market as a liquidity matter. We all have many people in Hong Kong. We have 2,500 people. It's a great business to interact, and once that confidence starts to build, then the capital will move.
Yeah, absolutely. And that's why Hong Kong, HKMA, and all the Hong Kong government and all the regulators in Hong Kong really want to continue to build Hong Kong as a platform to facilitate the capital market efficiency for mainland China, mainland companies. This is the role that we are going to play. Thank you very much. Let's put our hands together to thank the panelists for a great session. Thank you very much.
Thank you, all panelists, for an excellent panel. Please stay on stage for a photo. We'll take 2 sets of photos. First, in the middle, to our official photographer, please. Please stay for another set of photo to your right after the middle one. Please stay for our photo to the right. Our media friends over here. Thank you very much. You may now return to your seats. We'll now take a short break. Please be back by 11:20, and please enjoy your break time. We have coffee and refreshments at the foyer area. Thank you very much. The next session will begin shortly. Please be reminded to get seated. Thank you. The next session will begin very shortly. Please take your seat. Thank you very much. The next session The next session will begin very shortly. Please kindly take your seat. Thank you very much. Welcome back, everyone. Hope you enjoyed the break. Our next session is going to be on AI and digitalization of finance. AI and the digitalization of financial services is reconfiguring the way financial institutions operate, bringing a variety of benefits as well as new challenges. Our next panel will take a closer look at how to navigate the increasingly complex intersection of technology and finance. Let's welcome our moderator, Julia Leung, from the Securities and Futures Commission, and our panelists, Mike Gitlin from Capital Group, Jenny Johnson from Franklin Templeton, Danielle Pinto from JP Morgan Chase, Peng Zhao from Citadel Securities. Julia, thank you.
Thank you. So I finally got your attention. Now I'm glad to lead this discussion on two of the most exciting topics to shape the future of finance. Now, as we all know, technology is not new. It has been a driving force for changes, the way that portfolios are being constructed, the way that deals are being made, creating new opportunities in enhancing efficiency and customer experience. But recently, the pace seems to be picking up with generative AI and digitalization, which seems to have immense potential to further accelerate that change. However, with these, they also come with risk. And new risks have arisen, and there's even talk of existential threat to human. So we must ensure that technologies are being responsibly adopted and safely adopted. And that's, for many firms, it could be cash burning as well. So today I'm very pleased to be joined by four very prestigious panelists to shed light on how technologies are changing and reshaping the financial services industry. Now, speakers on these panels have a tendency to market their services. I would do the same for our circulars and our regulatory framework. Now, just last week, the SFC has provided guidance to the industry about the deployment of generative AI large language models. While we encourage licensed firms to be using that technology to innovate, to raise productivity, but at the same time, generative AI amplify existing risks, and we should be more cautious about. So what we are calling on licensed firm is to take a risk-based approach in your deployment and in areas covering senior management responsibility, AI model risk, cybersecurity, data, and third-party vendors to be a little bit, pay a lot more attention. For digitalization trend, Bitcoin may be surging past 90,000 US, but and where it is heading is not our concern in this forum. We will be looking at the bigger picture of digitalization and tokenization of assets, from bonds to money market funds, and how the financial markets can benefit from it. SFC and the HKMA are working closely together to scale up the tokenization markets and expand the use cases. And for that to happen, there's a need for an enabling and interoperable blockchain foundation layer and a coherent rulebook on blockchain-based financial services. And this is what the HKMA's Assemble Sandbox is doing, and there are recent fruits coming out of that sandbox, like tokenization of money market funds by a local bank using tokenized deposits. So in this process, we try to identify issues, particularly regulatory hurdles, and provide clear guidance. And we do expect that it's only with clear guidance from regulators can we see the convergence of DeFi and TradFi, with the latter providing the much needed trust and compliance in the Web3 space. So let me kick off by taking the first topic on AI. And to start off, I would ask each of you a question to rate your firm's use of AI from 1 to 10, with 10 being the highest. Now, this is not a competition, so you don't, because you are in totally different areas. Just describe the areas of application, but more importantly, to see where your firm is 3 years from now in the use of AI. I'll start with Mike.
All right, I wish 35 years ago at university they asked us to give our own grades. I would have done a lot better. Look, I think it's impossible to give a numerical rating on something where you don't know where the finish line is. And the finish line, when you do think you know where it is, will continue to move. The way I think about it from a capital group perspective is we use technology for 3 reasons, right? 1 is to make our business more efficient. 2 is to service our clients better. And 3 is to generate better investment results. On the first one, and we just use real examples, on the first one, I sent out a message to our 9,000 associates called 30-30-30. And it was, please reduce the number of meetings by 30%, reduce the number of people in the meetings by 30%, and reduce the gold-plated PowerPoint presentations by 30% so we can be more effective. So how do we do that? In our Teams system, you can be late to a meeting and hit a button that says, catch me up, and it catches you up. Or you can entirely miss the meeting and let the other 10 folks carry on and get a summary and action items for yourself on what you needed to do coming out of the meeting. If we save 30 minutes for every associate a week, we would save 14 million minutes a year just by being willing to miss 1 meeting once a week for 30 minutes. So you see the scale you get from something like that. In a client-facing role, we use PrepMe. And PrepMe means as you go out to spend time with clients, what are the 20 or 22 inputs about the client that would make the meeting more effective for them, not you? And that technology is very helpful. And then in the last one for our investment group, we have something called Blue Team, Red Team. Assume we are large owners of Netflix, just as an example. Much greater than any benchmark, much greater than competitors. The other, what we use technology for, is to create the bear case. So we don't live in our own echo chamber. And then one of the analysts takes that AI-generated bear case and conducts a debate with the folks who are the largest holders just to challenge our assumptions. So just trying to bring those examples to life on how we use it.
Okay, you refuse to grade yourself. So Jenny.
Well, because Jenny will have a higher grade, so I knew she was going second.
No, because actually I agree with your point, which is, so which is what's the scale? Like, I'm pretty sure everybody here has been using machine learning in their company for a decade. So if you want to measure that, we'd all rate it really high. So I asked, our Franklin Equity Group is housed in Silicon Valley, and the CIO is an engineer and with a tech background, and he's the one driving it so much through the firm. He literally, in a meeting, grabbed from the tech guy to show the other investment people what you can do with Quarter Pro and Perplexity and some other tools. And he rates it a 3. And I was thinking about that, and I thought, he's focused on it all the time and pushing his team to be thinking about the efficiencies that they can, not cost efficiencies, but time and information efficiencies. And I was thinking, you know what, if I come back next year and you ask the same question, we will have done a whole bunch of stuff, and I'd probably say it's a 3. Because the problem is that we're just starting to open up what the opportunities are and how we're thinking about all of us as an industry. If you look at technology innovation, the first thing that people do is they just make more efficient and improve the things they do today. Because they can't yet envision what the technology ultimately will do on the disruption side. And you have to get your teams comfortable with using the technology before you'll actually get to see what those true disruptions are. So I think that wave hasn't really hit us yet. And then I was thinking about my operational areas, and we have some great stories, great examples of where we find efficiencies. But then I started to think about all the service providers in this room and how they're going to have all these efficiencies, and what do I need to do in my contracting to make sure that those appreciate. Daniel, over to you.
Thank you. So AI has been a 10-year journey. So traditional AI. And on that, we have many, many use cases on automating reconciliations, credit decisionings, embedded in trading algorithms, fraud and fraud detection and fraud avoidance. So that is being, and from research to center of excellence to embedding it in each of the lines of business, that has happened and it will continue happen. So instead of giving you a rating, I will give you numbers, real numbers of JP Morgan. So we do measure the impact of all this. And the impact for last year was around $1.3 billion, either cost avoidance or increase in revenues. And this year will be around $2 billion, a big increase. And $2 billion is a lot of money, but the top line of JP Morgan is $170+ billion. So you can argue that all that we have done is increase productivity, but a bit over 1%. But I think that we are at the very, very beginning, and the confluence of traditional AI and large language models, they are going to really change and going to be a big, big productivity gain. And I'll give you one example. 2 years ago, we asked one of our PhD experts in artificial intelligence to look at one of the operational processes, that is Know Your Clients, KYC. In 2 years, by automating, going through processes, applying automation through AI, and we haven't yet touched large language models, the cost of processing a file has gone down by half. And I think that in the next 2 years, it will go down by another 2.5. So going forward, so large language models that we are at the very, very beginning, I see 3 phases. First, you give the people the model that comes out of the box, and you will have some marginal productivity. Then you move into really knowledge experts, where you complement the models with the knowledge of the company, and then you can do calculations, you can do data inquiries, more related to the company and things like that. It will be some more improvement in productivity. And the third will be agents that we're really going to see the big improvement in productivity. So in the next 3 to 5 years, for me, the biggest impact will be towards productivity, a lot of more of top-line growth. And that will be in operations. That is like 50, 60,000 people across JP Morgan. Efficiencies in data, in global call centers, and technology developments. I can see in all these 3 a massive improvement in productivity as we continue deploying, reviewing processes, continue to deploy AI, and deploying large language models in percentages that it could be very, very substantial.
Thank you. Peng?
First of all, thank you for having us here. Fall in Hong Kong is one of my favorite times, and there's always excuse to come back to Hong Kong this time of the year because this wonderful event you'll organize. So I look at the question a little differently. I think from our vantage point, one of the critical things that we focus on is in which areas we want to work and strive to be a 10, and in which areas we want to work and strive it to be a 0. So knowing which areas we expect the highest amount of return from the investment in AI and automation in general, and which areas it likely turn into a giant science experiment, a waste of resources, has been the key focus for myself and my leadership team. Certainly in some areas where it involves gathering a large amount of data, information retrieval, AI and large language models have brought in a higher quality level of processing power that we've been seeing in the last few years, and there's a real acceleration here. Keep in mind that we have about 1,600 people, but we transact somewhere around $500 billion of daily transaction across more than 50 countries. So anything that happens anywhere in the world, it could be in languages no one at the firm speaks. If it moves the market, if it moves the instruments that we need to transact in, we have a desire to know that. So a lot of these technological breakthroughs in natural language processing, large language models have increasingly allowed us to retrieve data, process it, model it, and understand it on an increasingly automated basis as well. So the approach we've been taking is really look into what are our most important workflows, and how do we get better at that, how do we get more productive and efficient at that, or the most pervasive workflows. For example, we often joke that the most commonly spoken language in our company is C++. So getting our developers to write code more efficiently would be one of the most common workflow we have around the firm. But we try to not get stuck in between. If we don't pick an area as an area of focus where we're going to deploy, we try to not touch it at all. So very top-down, lay out different areas, and figure out where we want to get to a 0 and where we want to get to a 10. So I don't know how you weigh the 0s and 10s and get up to an average number, but so far I think we've been doing a pretty good job.
So it's either 0 or 10. So which area we get a 10?
Again, in the areas of our core competency, retrieving data, processing data, making sense of it, to figure out how to get to a good price and quickly and efficient way, how to facilitate these transactions in the most seamless, error-free fashion, we will always strive towards a 10. And by the way, a lot of times that just takes good old-fashioned automation. It doesn't always involve Gen AI, large language models, or at all. Those are tools at our disposal, but just because we can use those tools doesn't make them the best tools possible. Yeah.
This is a very good excuse to look at every process in the company and start at the basis, even forgetting about the AI, just looking at the process and making it efficient, and then automate on top.
Mike, it sounds like our service contracts with JP Morgan are going to get cheaper.
I think you're right. Thank you, Nano.
Now, I've noticed that it's never a simple question. Only Jennifer answer it, like from 3 to 6. The men in the room have a different, very thoughtful responses. Now, I would dive a little bit deeper into what Peng said about the use of generative AI in trading. You've actually laid it out quite well. We've always known that traditional tools work very well in terms of like reducing spreads and enhancing and giving you the data and analytics. But with the use of that traditional technology, we already see a huge increase in trading volume, liquidity, but also volatility. Now, if generative AI is going to do a better job, a quicker job, so are there any concerns that it will exacerbate the trend of herding behavior, which Gary Gensler talked about? Any concentration risk, particularly when the AI model are provided by a few providers right now, and whether they are very similar, driving to very similar trading decisions, and how do you mitigate those risks?
Well, thank you for that question. I actually forgot. I should thank Howard for giving us the shout out on the last panel. It was quite a surprise. But I mean, look, when we started over a little more than 20 years ago, if you look at how a typical investor would transact in the United States, if they want to buy or sell stocks, you need a minimum deposit of $10,000. You got to call your broker every time you want to trade. To make a trade of a few $1,000s, you got to pay $100 in commission, right? And on top of that, if the day after election and you want to rebalance your portfolio, so does everyone else, you may have to stay online and wait for your turn, and you may need to wait for a long time before you get connected and call back again. Today, you need a smartphone. You need $100, sometimes not even. And you have a transaction cost that's lower than most institutions without commission. And all that happened because the tremendous amount of efficiency automation have created. The entire workflow from the moment an order is placed to a moment the order is executed has been automated to such a degree, the cost of executing that and facilitate that went from $100 plus to almost nothing. Right? That is a possibility of what technology has enabled. And you look at U.S. household, something like 62% of U.S. household own a stock, either directly or through a fund. Right? That number is about 20% for Japan. That number is less than 10% for China. So that really powers the economic development and growth and prosperity of the United States. And so much of that could not have happened without the power of technology, analytics, and automation. Now, there is the concern that some people are asking out loud, which comes in the following form. Can the product be so good that people like it so much, people use it too much, right? I've never seen the solution to that sort of concern to be, let's make the product worse so that the clients or consumers would use it less. That's never been a successful solution in anything I've seen. Or the question could be asked in the following form, that is, hey, people didn't quite have transparency. They didn't know what was happening to the stocks they were following or had an interest in. Now they have unparalleled amount of transparency, and the amount of information you can get just by logging onto your app is dwarfs where a traditional or a professional trader had access to 10, 20 years ago. So you all of a sudden could ask the question, could there be herding? If all of a sudden everyone have access to the same information, whether you're a professional trader that got paid $500,000, $1 million a year, or someone who only have $100 in your broker account. The answer is, it's not bad to have everyone to have information. In fact, that's a huge step forward. Transparency is good. But there could be a step too far if we take away the individual's need to make their well-educated, well-informed decision, and we start making decisions for them. Right? That is the fear of what generative AI may do, and then all of a sudden we'll just tell everyone what stock they should be buying and selling. I think we're pretty far from that. I think a lot of the people in this room run some of the largest brokers and wealth management firms for their clients. I don't think any one of them will tell you, hey, they're ready to have their AI agent to tell their client what stocks to buy or sell without real advice and input. I think we're pretty far from that.
Very good intro into what I'm going to ask Dan about guardrails and risks and whether we're too much reliant on generative AI when we are going down that journey.
So clearly at the moment, no, because we are at the very, very beginning of it. But when you think about the control environment that you need to have around generative AI, is by far more complex than what we did for traditional artificial intelligence, where we learn how to analyze the models, we can explain how the model works. We have done a very good job, most of the companies, in managing data and data accuracy and data privacy. So all done for traditional AI, I feel that most of the companies are in a good place. So when you go into large language models, so it all gets a bit more complex because these models have, first, you may not have access to the model itself because it's provided by someone else. But even if you were to have it, so it has either millions or billions of parameters. So the way that you have to explain the model is more to the output of the model rather than by the functioning of the model. So these models are still, though they are progressing very fast, they still hallucinate. So there are errors in the models that probably the partnership between us that we are using the models and the one that are generating the models will have to work to improve that situation and reduce that risk, and have models that they are going to control the models or check the models, and we are working in that too. And data is another issue. So we are in a good place, but it's still a long way to go in order to make sure that the usage of data that is going to grow so much is to a quality that respects data privacy, that we don't violate any of the rules there. So when you are using it in quantity, it's by far bigger than we ever did. And then one simple thing also is to train the people. So we deploy large language models off the box to 220,000 people. So now we are training to do the basic things. So these are not the second phase. It's like the first phase of model. So we need to train the people in order for them to be aware of the good things that come out of the models and not the so good things that come of the models. And the last one is the work that we have to do with the Microsoft of this world, so all the others, to make sure that we reduce the risk of unforeseen events going forward. And just one more comment on regulations. I think that hopefully all these companies, they are very, very highly regulated. So there is no need to regulate AI, because AI should do what the regulation tells us to do today. So it's about controlling the risk, and hopefully the regulation goes that way rather than trying to control things that they already massively control and regulated.
Your point taken. We are not regulating the activity, not regulating the AI itself, certainly, but certainly have to look at the risks that generate out of it. And one of the risks is hallucination risk. I'm going to ask Jenny to a live example, because you are also announced a partnership with Microsoft to build an advanced financial AI platform to improve the productivity of sales and also personalized client experience. Now, as we know, there is a question with the majority of fund manager using the same providers to produce investment decisions. How are you comfortable and how are you going to generate alpha? But also the question I asked about mitigation of hallucination risk. Daniel's already talking about, now machine learning is less of a black box because it's more predictive and you have a formula and algo. But then with generative AI, you are actually even black box. And so how comfortable are you without any human in the loop and providing that investment advice to your clients?
There's a lot in that. So let me first just talk about the Microsoft partnership. So we approached Microsoft with a very simple problem that has a very difficult technical solution. And they were excited about, because most people are approaching AI with a simple proof of concept on, let me reconcile, we do it too, let me reconcile this data, let me generate this RFP. This is more of a platform. And so the simple problem is, how do you optimize the conversation, say, a salesperson has when they go visit a financial advisor? And so you need the AI to go in and look through your CRM system to get whatever information you have there. You're going to want to understand the holdings. You're needing to go to external third-party data to compare kind of performance. You're going to want to look at your own performance data that's going to be able to figure out which is the most optimal opportunity to pitch to the advisor. You're going to go look at social media, and you're going to figure out, what kind of personal connections can I make. Each of those things requires a different AI algorithm. That's the technical problem, right? So it's that integration. And, I would say large language models are like the kid who gets an A in English and an F in math. You have to marry them and integrate them with very specific algorithms that can calculate things. And each of those end up being very specific. And the skill set of the programmer to build those models is different. And so Microsoft actually liked the idea behind it and are supplying us with quite a few resources to build it because they want to get the domain knowledge to understand how they can ultimately go to other firms and say, hey, we can help you do this, right? We're doing the same thing on the investment side, and it will be Microsoft or somebody else, where from an investment person, think about, you have an idea and you want to, let's say you were covering transportation, that was your sector, and you're wondering what, the global positioning system technology might disrupt, right? Think about how much it did ultimately disrupt with Uber and other types of car servicing or shared car services. So you'd ask the question with kind of a ChatGPT interface. It would go through all your analyst reports. It's going to go through the street reports. It's going to look through what kind of people have been talking about it, just massively evaluating information, bringing it back. And then the key is, and that's dealing with hallucinations, is you have to have a human who's evaluating it and able to prompt the right questions, right? And so that's where the skill set and having kind of the curiosity is going to be really important in employees to be able to iterate, and that's where you ultimately get your alpha, right? It's just about being able to consume a whole bunch more information in a way that you can consume it quickly, and ultimately still the human is making an investment decision.
So there will be a human going through this before you hand over
At
the
Franklin
information.
Templeton, there will be.
Yes, all right. So Mike, you're one of the largest active manager, and is known for your research and fundamental research and analysis. So how are you going to marry this AI thing with your portfolio team and the research team?
It's interesting. If you dial back 25 years ago and you think about .com, make up a fake company, a cement company called World Cement Company. If they would have changed their name in 1999 to cement.com, the stock would have gone up $50. And so when our folks are looking at AI, you have to be really careful in not indexing AI, because that's really hard to do and it's dangerous. So any company you own that changes their name to something AI, you should sell it. The other thing I would say is you think about it in different levels. The participants in AI, everyone's seen that 4 stack or the 4 rungs on the ladder. And if you think of semiconductors and infrastructure and models and applications, one thing you'll notice on the 2nd, 3rd, and 4th rung of that ladder is there's some companies in common. Microsoft, Amazon, and Google or Alphabet are all in common in the 2nd, 3rd, and 4th rungs of that ladder. So I think that's something to be mindful of. You also look at the other impacts. People are talking about AI, but they're not talking a lot about AI robotics. Waymo from Google is basically a 4-wheeled robot. It's self-driving in 4 cities. They're doing 150,000 pay rides a week. They'll be at annualizing at 8 million, and they're just scratching the surface. Who in this room doesn't think in our lifetime you won't see self-driving cars gain a big market share in the marketplace? I think we all know it's coming. If self-driving cars were 10% of the miles traveled in the world, that would be a $150 billion profit pool. Our analyst looks at something like Google and sees Waymo not even impacted in the price in Google today. And you think about that kind of optionality over the long term. And Amazon with Sparrow picking 100 million items in 7 seconds with a low fail rate, drone delivery, these are all super exciting. The last part I would say is utilities. I was in New York last week and I saw our credit analyst who looks at utilities, and he said, I never thought I'd be a tech analyst. And I never thought I'd be in the growth sector. And utilities, you have to do both right now. And it changes a lot of things. So, John was talking about data centers. regardless of anybody's math, everyone's pretty darn sure data centers will be more than double its current share of energy consumption in the US in the next few years. So these are going to be really important. What do data centers need? Cooling. Who's doing the cooling? It needs 1 million tons of copper. That changes your commodity outlook. So all of these things are really important when you're trying to do bottoms-up research and figure out who are going to be the winners and losers.
All right. So let's move to digitalization, digital assets and technology. Now, BCG estimates that the market size of tokenized assets could reach 16 trillion US dollar by 2030. That's the equivalent of 10% of global GDP. So Jenny, you said you spent 30% of your time looking at disruptive technology, and tokenization, you mentioned, will be the most disruptive trend in asset management over the next decade, leading to all mutual funds, ETFs, I don't know whether I'm misquoting you, being on the blockchain eventually. So what is Templeton doing in terms of positioning yourself and the insights you gain from the various really frontier pilots that you've been doing in Europe and also in Hong Kong with HKMA's Assemble box?
I believe I said AI and blockchain will be the two most disruptive technologies. Look, we started getting involved in blockchain, just starting to build things within the network around, I don't know, 2017, 2018. And then we had an approved tokenized money market fund in the US in 2020. I believe we're the only one running the actual money market fund, shareholder record, and transactions on the public blockchain. The other ones are shadowing the transactions on the public blockchain. And I'll tell you why that's an important distinction in a second. And then we started almost falling into it, but being what's called a node validator, where we validate transactions as part of the public blockchain on, I think, 13 different layer 1 or layer 2 platforms. And what we realized when we did that is, if you're going to be in this space, you have to actually participate in the network to be able to have the information to kind of make some of the decisions around there. So why am I excited, and why do I say that I think it disrupts, ultimately, mutual funds and ETFs? I have to tell you, Franklin Templeton ran 4 shareholder record-keeping systems globally up until recently when we outsourced it to, I think, this guy. Nobody ever asked what programming language any one of those systems were in until it was written in blockchain. And the most important thing is just remember, this is just a really efficient technology, and each different chain optimizes for different things. But we were astonished when we got the money market fund approved and we parallel processed between our old system and the new blockchain system with how inexpensive it was versus the old system. And so that one, from a cost standpoint, I think is really important. The second thing that's going to be important, this is why the distinction of managing the tokens truly on the public chain in a wallet, is because if, for example, today we work in Project Ensemble with HKMA on a tokenized kind of stable coin, but ours will be a yield coin. If people are trading on the weekend and your transactions are part of a money market fund and they're just shadowed, they can't transact until Monday, right? And so if I need to transfer my token to Mike for collateral, it can't really happen truly until Monday. But if it's an actual tokenized unit, the settlement, everything goes with that. And then because it's a smart contract, you can have the NAV that's calculated immediately. You can have the KYC done as part of the token. All the things that we do can ultimately, now some of this is a bit out there, but ultimately can be embedded in that token, which is going to drive out a bunch of costs and friction in transactions, which is going to open up new types of investment opportunities. So that's why we're excited about it.
But you will need scale. You will need, if you want transfer across different banks, you will need an interoperable blockchain. So what are you doing? Do you see that scale?
Need scale in what way? What do you mean by?
Well, if you are selling all your prediction, all your ETF and mutual funds will be on blockchain.
So exactly. So we just got UCITS approval. You really need to have global regulatory approval. Our view is all of this gets regulated. right? It all gets regulated. And it's difficult because, as you know, nobody knows better than you how challenging it can be because of things like atomic settlement and others, exactly how you define regulation in an environment that is changing so quickly. You know, if a value of a token in Fortnite can be sold between two people, should that be regulated in a online gaming? So it's complicated to do. But what we found is that you really need to be able to transfer these tokens across a global regulatory environment. And so yes, from that standpoint, absolutely.
Yes. Peng, you're a chair of EDX, which is a platform for trading crypto. So where do you see that platform going? I mean, now that Trump 2.0, so will we see more of activities there or regulation there?
Yeah, so, you know, it started a little over 2 years ago in many of our conversations with our partners and clients and counterparties, where there was an emerging desire among our US-based partners to look for a more grown-up way of transacting in crypto, right? So the issues ranged from people were uncomfortable with the lack of separation between exchange dealer and custodian solutions. People wanted a more familiar setup for exchanges with co-location, standard protocols. People were looking for central clearing solutions and so on and so forth. So, you know, we got together with our partners at Fidelity, Charles Schwab, Sequoia, and Virtu Financial, and started putting together a bit of a consortium and started a crypto exchange that's supported and underpinned by what you call traditional financial institutions based in the United States. I think the plan initially had a heavy institutional focus. Then the regulations over the last 2 years, instead of providing additional clarity, in fact, muddied what is okay and not okay in cryptocurrency for US-based institutions quite a bit, right? So by and large, SEC led a enforcement-based approach for crypto regulation, which made it more and more confusing. Now, but over those 2 years, instead, EDX have really focused on connecting to and trading with US-based retail platforms instead. So on the basis of that, EDX has grown a lot. Q3, in fact, grew by another 60%. That's a combination of increased adoption from the various different retail platforms, as well as increased interest and transaction volume in cryptocurrencies in the United States itself. Post the most recent election, I think the industry consensus view is that we will likely find more collaborative regulatory approach for the transaction of cryptocurrencies in the United States. And in fact, we're already getting some incomings from financial institutions that essentially went away over the last 2 years to start re-engaging in exploring how they themselves or they can enable the best way they can enable their clients to invest and participate in trading of cryptocurrency as well. So we continue to invest in that, support that, and it does look like we're at this pivot point where US institutions are taking another serious look at the investing and trading in cryptocurrencies.
Daniel, it seems that the banks are taking a slower pace, maybe because of regulatory constraints, but you do have a successful platform for trading intrabank Ripple.
Yes, if you could ask me several years ago how much this will progress, I would have thought that a lot more than it did. And I think that one of the reasons why it didn't, is all the problems that happen with unregulated crypto exchanges, currencies, cryptocurrencies that came and go, created a very defensive approach from regulators. So therefore, the banks, at least in the US, we haven't been allowed to participate in public networks. We're only allowed in private networks. That makes the use cases a lot more limited. Yeah, we have experimented a lot in like intraday repos. We have a network of banks and the Monetary Authority of Singapore to process payments 24/7. we have done monetization and provide liquidity on tokenized money markets fund, but still very, very little. I think that this technology is so powerful that once it gets delinked to the good and bad of cryptocurrencies, it will probably evolve very, very fast. And I see, for example, in cross-border payments, a massive use case. In tokenized securities, a massive use case. So I think that this will accelerate over time, but at the moment it's been not as powerful as we would have hoped several years ago.
Mike, this time you have the last word. Remember last year you did not. So are we overestimating the change? Are we too excited about AI and digitalization in the next 2 years and actually underestimating that change that we'll make in 10 years' time?
Yeah, if you look at Netflix, it took 10 years to have 100 million users. It took OpenAI 2 months to have 100 million users. And now it has 200 million users. So we're in the noisy phase of implementation where there's just pride in the volume of activity in many people and less efficacy, but more pride. I think as you go through the cycle, it's going to be massively impactful to our world, AI in general. I think it will change jobs, it will eliminate jobs, it will create jobs, but it will be a huge impact for sure.
So thank you. Let's put our hands together for our distinguished panelists.
Thank you very much, Julia and our panelists. Please stay on stage for a quick photo. Please stay for another photo to the right, our media friends. Thank you. Thank you very much. You may now return to your seats. Asian economies have been at the forefront of global growth, driving innovation, trade, and investment. A growing middle class, increasing urbanization, and a focus on sustainable development are opening up new opportunities in Asia. Let us hear what our panelists think about the Asia outlook and opportunities in our next panel. Let us welcome our moderator, Bonnie Chan, from the Hong Kong Stock Exchange, and panelists, George Al-Hedri from Ge Haijiao from the Bank of China, Professor Huang Yiping from Peking University, and Bill Winters from Standard Chartered. This session will be partially conducted in Putonghua. Thank you, Bonnie. Over to you.
So it's past noon, so good afternoon, everyone. I hope you've been having a great summit so far. It's wonderful to see a lot of familiar faces from around the world here in Hong Kong. And because Hong Kong is at the heart of Asia, this next topic discussion is going to be about the outlook and opportunities for investing in Asia. Now, just to set things in context, let me canter through some facts. So Asia is, of course, as we know, the fastest growing region in the world. It has 60% of the world population, contributes nearly half of global GDP, and 60% of GDP growth. It has 3 of the 5 largest economies in the world, 5 of the 10 largest stock markets, including, of course, Hong Kong, and represents 1/3 of the global bond market. Now, at the same time, new growth drivers are emerging. The digital economy, we heard from the last panel, a growing middle class, advancement up the value chain, and of course, amidst all these opportunities, there are also challenges that complicates business and investment decisions, such as domestic economic fluctuations, geopolitical tensions, regulatory complexities. But no fear, because we have 4 heavyweights, experts on the region's investment landscape, to provide insights into the opportunities and the complexities. So without further delay, let's dive right into it And we're going to start with George because you are the newest kid on the block, shall we say? So let me turn to you for the first question. Asia has long been a strategic priority for your bank, HSBC. What's your current perspective on the Asian market, and where do you see risk and opportunities?
Thank you very much, Bonnie, and thank you, everyone. So we start with the heart of Asia and from Hong Kong, and let's talk a little bit about China first. Again, at the heart of Asia, China 40 years ago, GDP was $250 per capita. It's $12.5 thousand per capita today. In 40 years, the GDP is multiplied by 50 times. If you look at what China's achieved over that journey, over the last now 10 to 15 years, China's been the largest manufacturing hub in the world. China's been the largest exporter for more than a decade in the world. And China wealth has grown one of the fastest in the world. And if you look at Hong Kong, where we are here, Hong Kong's capturing more than 20% of the share of wealth creation movement offshore. And by leading consulting house, notwithstanding we're the Hong Kong bank, so I'll be talking my book here, but by one of the largest consulting houses, Hong Kong will be the largest offshore center by 2028 with about $3.2 trillion of managed funds for wealth, ahead of Switzerland with about 3.1 billion. So that tells you the journey that China's gone into and the outlook that it can provide. Now, starting 2017, tariffs have started to weigh on some of the economies, specifically on China. Then COVID, and then we went into a world frenzy of supply chain diversification, supply chain resilience, reshoring, and granted, some re-onshoring has taken place. But the reality, really, what has taken hold is the China plus one strategy by many of the global producers, supply chain, global corporates. The China plus one strategy meant we wanted to find alternatives to create resilience and to create de-risking of the supply chains with heavy dependence on China. Well, it turns out that the plus one has, in most of the cases, been here in Asia. The plus one has been the Vietnams, the Indonesias, the Thailand, the Malaysias, the Singapore, the Indias. The plus one, granted, has been Mexico, but my Mexican colleagues remind me they're part of Asia Pacific. So there is a lot of benefit that this region has captured from the plus one. Now, more interestingly, a lot of the plus one has been a China-driven plus one. So China's been asked and tasked to build the plus one. So when you look at the FDIs from China into ASEAN, we're now at about 50%, displacing inbound investment into, or FDIs into ASEAN from the US, from Korea, from Japan. China's become the largest. If you look at trade patterns, ASEAN has become the largest trading partner for China, ahead of Europe and ahead of the United States, with about 14% of the Chinese exports. But also, interestingly, about 30% of ASEAN exports is back into China. So there's a material benefit that, or material virtuous circle that's been created in Asia with this plus one, China plus one opportunity. If you look at trade patterns and trade flows between now and 2020 and 2030, we're talking about 5 years actually, we're expecting those flows, intra-Asia flows, to increase by another 65%. Now, this is massive considering they're already larger than many of the flows going across the Pacific. So it does give us a sense of the value of the opportunity here. I mean, we at HSBC, we have 60% of our 210,000 staff based in Asia. We have about 30,000 people here in Hong Kong, 30,000 people in mainland China, 45,000 people in India, 20 people in ASEAN, 20,000 people in ASEAN, another 10,000 people in Middle East, if we look at this as the extension. But if I turn to the challenges, there are many challenges the region is facing. There are many challenges that China's been facing, which we talked about. I'm not going to dwell on, but structurally the strength is there. Cyclically, the challenges have to be overcome. There are also challenges that we haven't talked about, and I'll call one out. This is a highly dollar-dependent region, and a high dollar rate dependent region. In other words, high dollar rates for economies with floating currencies is putting pressure on the currency. And the moment you put pressure on the currency, you put pressure on foreign direct investment and other financial investment. And then for those currencies that are either pegged or managed, high dollar rates means high funding cost and basically a break somewhat on the economy. And that's really particularly the case of Hong Kong dollar, that's faced with a very high rate environment due to the peg, but with a slower economic backdrop, and that obviously exacerbates the cyclical pattern that we're facing. Thank you.
Well, thank you for that. I do like the fact that we're starting the discussion about outlook and opportunities in Asia by talking about China first. But as we know, Asia is a very diverse region with developed high-income economies alongside a lot of emerging players in the ASEAN. So let me turn to Bill. As one of the largest international banks in Southeast Asia, what opportunities do you see in the region? And would you say that ASEAN is now a key driver of the overall Asian growth narrative?
Yeah, thanks, Bonnie, and of course, thanks, Eddie, and everybody for having us. I completely subscribe to George's views about the importance of ASEAN in its own right, but then vis-a-vis China. So, not to repeat what George has said, but the China plus one is largely going into ASEAN, and the trade flows are increasingly important. So, as one of the few largest trade banks in the world, our largest trade corridor is China-ASEAN. And it will continue to grow quite quickly. The opportunities from here, I think, are the greater unification of ASEAN itself. ASEAN, it is a trade pact, but it's nothing like a free trade zone. So the intra-ASEAN flows, either through Singapore or between these countries, are still a fraction of what they could be if ASEAN were to continue its process of political reform and unification. But Bonnie, as you say, it's quite a diverse region as well, with some of the wealthiest countries in the world, and as well as some lower middle income countries and growing. So I think the opportunities in ASEAN are huge. The region as a whole has tremendous access to some of the future minerals that will be critical. We're seeing in Indonesia. A big chunk of the EV supply chain is coming out of Indonesia today, and Indonesia, I think, has been quite clever about the way that they've effectively forced a vertical integration into Indonesia. So it starts with mining nickel and lithium, and soon you're producing batteries, and soon you're producing the electronics that support the battery production. This has been a real driver of economic growth in the region, and I think each country in ASEAN has that angle, or at least certainly the ones who have been most active, thinking Vietnam and Malaysia. And then there's Singapore, which I know that Singapore and Hong Kong love to pretend not to compete with each other. And all I know is competition is good because it makes everybody better. We're completely agnostic, I can tell you. I'll say the same thing in Singapore on Friday. We're completely agnostic about this competition. We want Hong Kong and Singapore to thrive. And I must say, and I know George is in the same position, but having a big presence in Hong Kong and Singapore, actually the amount of cooperation between these countries in terms of the core values of promoting trade, investment in Asia, being, say, responsible participants in the global economy and in global markets, setting wise regulation, there's more in common than there is different between Singapore and Hong Kong. And that, of course, makes me very happy because we don't ever have to criticize anybody. We can just praise all. But at the moment, we're here in Hong Kong, and man, is this place buzzing, right? I mean, for those of us that have been here for 3 years, to have come the first year as we were coming out of COVID, the second year to say, yeah, China and Hong Kong are relaunching, to come this year and feel a real buzz in the environment, that, of course, is reflected in all of our businesses, I think, which are doing quite well. And I wish many years to come. So thanks again, Eddie, for having us.
Well, thank you for that, Bill. And, I like your remark about, praising all. And in fact, a few weeks ago in Riyadh, we had this debate about whether the world is deglobalizing or reglobalizing, right? I'm going to go off script here. Do you think we have a chance of, doing more reglobalization if Asia worked together more?
Absolutely. I mean, there's two trading unions in the world right now that are way underdeveloped. ASEAN is one, and of course that connects directly through to China, and Hong Kong is a central participant in that. The second is in Africa, not the topic today, but there's an Africa free trade zone. It's just getting started. That connection, that trade corridor between Africa and the Middle East, between Africa, South Asia, between Africa and Asia, is big and growing very fast. So to the extent that we can get the internal cohesion in these trading blocks so that the logistics make sense, so you can actually transport something from Nigeria to China via Kenya and all the countries in between without paying tariffs and logistic charges, et cetera. Now, we're a long way away, but the commitment, the political commitment is there. And of course, when you've got a buyer at the end, which in that particular example is somebody in China, they're going to do their bit to make sure that that unification happens, because it's in their interest to have a sustainable supply chain with data that's cohesive, with a tax regime that's conducive. So yeah, I mean, all this globalization is dead, globalization is going backwards. Sorry, it's just simply rubbish. It's just not true. Globalization is as strong as it's ever been. It's just showing up in different places. Trade volumes are increasing. 60% tariffs coming out of some country to another country will not change the aggregate level of global trade. It will just redirect the flows. Of course there's a friction cost, and we're all going to pay for it. Of course there's a friction cost. But man, markets are so cool. They immediately re-equilibrate around the friction cost so that economies continue to thrive. So yeah, bumps in the road for sure. Globalization ain't dead and it's not going to die.
All right, we'll leave globalization as a separate topic, and you do it another day. We can talk for hours on that. But thank you for teeing me up for the next question, because as you said, it goes back all to China. So I'll turn to Professor Huang. So this morning we've heard from the leaders. Mainland authorities have announced a series of monetary and fiscal measures. And so far, I think the jury is still out, because it's drawn very diverse opinions from market analysts. So how do you think these measures should be understood and assessed? And what would be the broader impact on global investors? Would the potential changes in US trade policies have any bearing on China and Asia? That's a very frequently asked question in the last few weeks.
Well, I don't think there is any disagreement on whether or not the macro policy actually turned. The question is, I think, whether this is enough. I mean, the market is always disappointed by the fact that the number is not big enough. I actually think that's a psychological game. My own advice, obviously, is that the government should announce a huge number, because if investor expectation changes, then you don't need to spend all the money. So I think that is still the reason why we're still debating whether that's enough or not. But my own take is that I think whether or not that number is enough is one thing. The policymakers have made it very clear that if this is not enough, more is coming. In fact, the Governor Pan Gongsheng said on the 24th of September, more on the pipeline. The finance minister said something many people didn't notice, but he said the central government has ample room or potential to raise further debt and to increase the deficit. These are words you never heard from MOF minister during the past years. They always say we needed to be prudent, we needed to reserve room for further future action if it's required. But this is time, I think they made it very clear. So my sense is I'm pretty convinced that the policies are aggressive enough to turn around the macro economy. There might be some other issues still around, whether, for instance, what the local governments do would be supportive of the policy expansion. And sometimes I actually am thinking they are actually doing the opposite, because the local governments are fiscally constrained at the moment, and some of them cutting the salaries for their own employees, and they're also trying to create some new revenues, which is not very positive for entrepreneur confidence. So these are the things I think we needed to fix. But I'm not worried that the policies have already turned. Now, the vice premier and the 3 ministers also mentioned a term, incremental policy. I had some conversations with investors during the past weeks, and some said to me they were a bit worried because the government was saying incremental policy. That means probably piecemeal, gradual. In Chinese, 增量, incremental actually means additional measures. That means more measures coming. It's not like a very piecemeal or gradual measure. So just want to clarify, this is obviously my interpretation. But whenever they say incremental policies, it really means on top of whatever they have done, they are determined to do more to turn around the economy.
Right, so maybe the translation should not be incremental, it's accretive. I think that's what it meant. Anyways.
I'll make the recommendation.
Earlier, George talked about the +1 strategy, the go global. So I'd like to now turn to Chairman Ge to elaborate a little bit more. And the next little bit is going to be in Mandarin. So I'll give a few seconds for people to put on the headset. 各董事长，那近年来国际环境变化是不断的啊，那区域经济金融合作也正在经历很大的一个调整。中国银行呢，作为一个内地的龙头大行，你对内地企业客户今年走出去啊，我们所说的 +1 啊，这个投资的趋势变化有什么的一个观察？你认为呢？这个趋势会对国际金融机构带来一些什么的机遇和启示呢？
谢谢主持人，我觉得是非常好的一个问题。内地企业走出去呢，其实呢，我也在想思考这个问题呢。过去10年呢，发生了很大的变化。我们回到2014年，我们是招商引资，内地呢，我们更多的是寻求呢外商直接投资。2014年出现了一个变化，外商直接投资的增量首次呢跟对外直接投资的增量发生了一个变化，就是对外直接投资大于了外商直接投资。到2016年，又发生一个新的变化，就是这2个数据的存量，对外直接投资和外商直接投资 ODI 和 FDI 的存量达到了一致。最新的数据，去年的数据呢，在全球 FDI 呢下降的情况下，下降了超过2%的情况下，中国的对外直接投资增长了超过8.7%。这是一个我们从趋势上来看的时候是一个巨大的变化。同时呢，中国的对外直接投资呢，更多的是体现在呢对亚洲。过去5年呢，对亚洲的对外直接投资的占比超过了70%，说明呢，中国内地企业对亚洲市场是充满持续的信心。同时呢，在这个过程之中呢，非常显著的是，更多的对外直接投资的增量呢，是投向了“一带一路”、东盟，包括非洲。去年这个增量呢，都是非常巨大的一个对外直接投资的增量。同时在企业方面，也更多的显示出呢，我们更多的是在多元的领域，其实覆盖到了制造业、批发零售业、金融业、商业、租赁服务业，这些都是非常显著的增长。在这个过程中呢，中国内地企业对外投资的时候呢，也更多的关注呢可持续发展和绿色问题。更多的中国的企业在内地企业在对外直接投资的时候，是把融入当地社区，更多的呢是作为一个最重要的考量，不仅仅是经济效益，更多的是呢融入当地核心的考量。其实对我们的金融机构来讲，不管是中国内地的金融机构、国际的金融机构来讲呢，带来了很多新的机会。我觉得简单的说，可能第一个最大的机会就是，更多的对外直接投资的企业需要一个更多元的结算货币的选择，就是人民币如何在对外直接投资和国际贸易投资中呢能够发挥作用。我觉得给金融机构呢，国际金融机构、中国内地金融机构呢，在产品服务上提供了更多的新的需求。第二个呢，我觉得这个过程中呢，就是香港可以发挥更大的作用。依旧呢，香港这个平台的作用呢，帮助内地企业对外投资的时候呢，我觉得从税务、 法律，不仅仅是金融，运营能力、人才优势还是可以继续发挥作用。第三个呢，对金融机构来讲呢，就是特别是国际金融机构呢，对于绿色发展的理念呢，具有足够的经验。内地企业可以呢跟金融机构之间呢有更深入的互动。我觉得。
好的，那个或者追问一题啊，因为我们都知道那个金融是服务实体经济的。那你刚才也说了，那个在这个出海啊，这个 +1 当中，那有很多的领域，包括是一个绿色的转型啊等等，都是重点发展的一些方向。那么我们早上也听到领导们他们说要推动内地的高质量发展。那么我希望可以再听一听各董事长，你对这一些高质量发展方面到底你认为重点的那个行业，除了刚才说的绿色转型以外，还有什么我们应该关注的？而且呢，更重要的是内地的银行业，你们做出了一些什么行动来支持配合内地的经济发展而且这个又带来给国际的投资者一些什么机遇和风险？
内地的高质量发展和银行业之间的关系呢，在过去30年、过去20年、过去10年都发生了显著的变化。除了刚才讲到的这些呢，刚才杨教授也讲到了内地的增量政策带来的推动高质量发展。过去10年呢，特别是过去5年呢，推动经济高质量发展的过程中呢，银行业的金融服务，尤其是内地银行业，其实呢，在支持科技创新方面是起了巨大的作用，在支持呢普惠小微企业发展方面起了巨大的作用。到今年前9个月的各种数据表明呢，在这些方面的金融支持，在经济呢在一个相对低的一个增长的情况下，金融机构对这些行业的支持呢，还是都有超过10%以上的增长，这个是非常显著的。我们从金融的从业者的角度看的时候呢，我们在这个方面的投入，是在过去相当长一段时间里呢，是一个持续保持高增长的态势。这也促成呢中国的科技创新，特别是绿色低碳的发展能够取得现在的一个成果，金融支持是密不可分的。另外一个方面，在整体上这个过程中呢，尤其是今年的我们所谓的增量政策推出之后呢，我们能看到呢，内地市场的信心、国际市场的信心也在发生变化。11月份以来，大家看到呢，沪深两地的股市日均交易量呢都在2万亿以上的一个高位运行，这个信心是在恢复之中。债券的发行规模前9个月也超过了60万亿，接近这样一个体量，增长超过了13%。同时，信贷规模也在达到了超过接近260万亿的一个增量的规模，在这个过程中呢，也达到了8%的一个增长。整体上，这个信心的变化带来呢，比如说最新的，国债收益率也已经呢，最新的10年期财政部的国债已经降到了2.01这样的一个水平，比6月份还是一个显著的下降的水平。其实市场的信心呢，我觉得在发生变化和恢复。给国际投资者和国际金融机构呢，我觉得会还是带来更大的一个利润的空间和增长的空间，潜力依旧是在科技创新和绿色转型方面。
好，所以高质量发展，English translation of that is high quality development. I think maybe we'll stick on the theme of these terms, which sometimes is quite difficult to appreciate once it's translated. So with the new the high quality development, there is also another term that we hear frequently, which is 新质生产力, right? The new quality productive forces. So maybe I should ask Professor Huang to help us understand that better. Now, China's growth rate obviously has seen a significant adjustment, right, from about an average of 7% between 2011 and 2019 to now about 5% in the post-COVID era. It's still an impressive figure, of course, considering that it's the second largest economy in the world. However, what is going to sustain this growth, we heard, is going to be a shift in the economic model and focusing on this quality growth, this 新质生产力, right, the new quality productive forces. Professor Wong, perhaps you can help the audience understand how this transition is progressing and how we should actually look at the opportunities embedded in it.
Well, I think you probably heard the term the middle income trap before, which is not a scientific term, but it basically says many countries can rise from low income to middle income. But most countries would not be able to rise to high income. That's World Bank data shows. For China, I think what we're facing at the moment, and our school actually did a joint research with the Brookings Institution and look at the growth outlook for the next 30 years. The key finding was economic condition is already changing. Regardless of the past success, we are entering into a new phase of development, and I can at least summarize 3 key changes. Number one, the low-cost advantage is gone now. Income level is much higher. Number two, the population dividend is replaced by rapid aging of the population. And number three, well, we're still very positive about the globalization, I heard from Bill, which is true to some extent, but the external environment becomes much, much less open and friendly for us. So the question is, how do you continue your growth in this new environment? And I think this is the background of what Bonnie just mentioned, whether you call it high quality development or new productive force productivity and so on. Bottom line is, for us economists, bottom line is you need to raise your total factor productivity. You need to remain competitive in this new environment. So I think this is why we're all looking at the new sectors we're pushing. The key question I think it boils down to is, well, can China innovate? When the cost is becoming higher, when the external environment is less friendly, when labor supply could actually be declining over time. The impression, I think, by Westerners on China's national creative capability is very extreme. I found, I give you an example. In September last year, the US Commerce Secretary Raimondo came to Beijing, and she invited Professor Yu Yongding and myself to lunch with her, a small lunch. Her first question was, what is happening in the Chinese economy? Because all the opinion pieces she read in the Western media appeared to suggest that Chinese economy was about to collapse. And then in April this year, we received Janet Yellen, the US Treasury Secretary at our school. Her first point was, your overcapacity in the EVs and other green energy sector is going to eat our lunch. So I guess this is what I'm telling you. Some people say China has no innovative capacity at all. And others say, well, at another time, they say, well, China is going to take all their opportunities of new products. I think the reality is probably somewhere in between. China can innovate, but most of it is still in applied field. Even when we talked about the AI, China is rapidly catching up, but most of them is in application, not original research. So for instance, look at the EVs. The US complaint is about the state subsidy, but if you look at the state subsidy, we have scholars looking at the actual subsidy per unit of EV. China was somewhere in the middle. The highest was Norway, the second was the US, followed by Germany, France, UK, and so on. So state subsidy was an issue, but it's not the key reason why the EV industry expanded very dramatically. I think the local government probably helped in expanding the capacity, but that's another issue. So I think the question now is, can China innovate? My sense is we can. But the problem or the question is, I think we should push to innovate in a large number of industries, not just in 3 areas. So policies still have room to improve. If you look at, for instance, Michael Porter, a professor from Harvard Business School, he looked at the so-called innovative capacity, and he has a long list of the factors which are very important. These are the factors I think we should look at in China. And the two most important factors at the moment, number one is we need to keep the country open, because you can't imagine that you can do all innovation by closing the door despite all these geopolitical tensions. Number two, the dynamism of the private sector, which is vital.
Thank you for that. You know, we do need more different manifestation of the new productive forces. And, you know, I really want to carry on this conversation, but unfortunately, the countdown clock is in negative territory right now. So we do have to end this very fascinating, insightful conversation. My thanks to George, Chairman Ge, Professor Huang, and Bill for the very insightful discussion. And I hope we can do this very soon again. And of course, thank you everyone for joining us. I hope you've enjoyed the conversation. Thank you.
Thank you very much, Bonnie, and our panelists. Please remain on stage for a quick photo. Thank you. And to our right, please. Just one more to our right, please. The photo over there. Yeah, thank you. Yeah. Thank you very much. You may now return to your seat. We've now reached the final panel before lunch. The past 2 years have presented significant challenges for private market investors, with slower fundraising, higher interest rates, and a macroeconomic outlook clouded by geopolitical tensions. Despite these challenges, private investors' demand for private assets remain resilient. On our next panel, our speakers will share their thoughts on private market capital deployment in the current environment and where they think present the most compelling risk-return opportunities. So now let's welcome our moderator, Neo Shen from Hongshan, and our panelists, Zhou Bei from KKR, Jim Coulter from TPG, Rob Lucas from CVC, Howard Marks from Oaktree, and Harvey Schwartz from Carlyle. Thank you. Neo, over to you.
Thank you. Thanks, HKMA, for inviting me, and it's my great honor to moderate this session. We got 5 heavyweights in the private markets. I guess private markets really play a very, very important role, as Mark was, alluding to in the early session, that oftentimes was feel it's more risky than the public market, but it turned out to be safer and creating better returns. So let's start from Howard. You have wrote letters all the time, and one thing you have mentioned about the sea change that you mentioned 2 years ago highlight that a substantial portion of the investor return over the last 40 years because of lower interest rate environment. And the year ahead won't be that easy. So can you share a bit on that particular note, like given the rising asset price and the declining cost of capital, before for the private equity, and now, what are we gonna expecting to see in the future?
Thank you, and thank you for giving me the opportunity to be here today and on this great panel. In the memo, I said that in 1980, I had a bank loan outstanding personally, and I got a slip of paper in the mail which said the rate on your loan is now 22.25. And 40 years later, in 2020, I was able to borrow at 2.25. Now, I hope I became a better credit, but I think that was a very, very important factor in the history of the world. In fact, I think it was the most important single event in the financial world in the last half century. Now, it took a long time and it was gradual, so it might have gone unnoticed. but very important. And so that's number one. And of course, declining interest rates make, among other things, make assets more valuable and make the cost of borrowing less. So that leads to number two, which is that something we call the leveraged finance industry was invented in that period. And, private equity and, of course, the growth of real estate and other leveraged strategies. And, of course, the beneficial effects on the value of assets and the cost of carry were very helpful to those industries. And they got traction. And, of course, private equity, which my co-panelists are the leaders in, have been described as the silver bullet in the last 5 or 10 years for any pension fund which is underfunded. So that's very, very significant. And then, of course, in the 09 to 21 period, we had the lowest interest rates in history. The Fed funds rate was 0 most of the time and averaged 0.5%. And that was a great time. Now, that brings us up to date, almost. But in that period, when credit is readily available and almost free, what's the smart thing to do? Leverage up as much as possible. And a lot of people did. Now, of course, things have changed. We had a bout of inflation that required the Fed funds rate to be raised from 0 to 5.25, 5.5. And many investments were saddled with capital structures that didn't anticipate a 500 basis point increase in rates. And they'll have to go, some have adjusted, some more will have to go through a period of adjustment as we get maturities, et cetera. But I think the important thing is that when leverage is not as cheap and not as readily available, the ability to produce returns will come from being able to buy things well and add value, not from merely buying, levering, and enjoying an increase in multiples. So this is a lot of what our industry has to do ahead. In this period, I think what I would say is beta will not be enough, market trends. It'll take alpha, personal skill. I think that, I'm sure Mark is right, that private credit has gone from about 250 billion in 07 to about $1.5 trillion today. So 6x in 17 years is a hell of a growth rate. I'm sure it'll keep growing, but we all know that in that period it didn't really, the tide didn't go out, to paraphrase Buffett. We didn't find out who's naked, and one of these days we will. So that, I'm just trying to set the scene, and I look forward to hear what everybody has to say about this environment.
Great. So have to buy well and seeking alpha. Harvey, so you have a Washington roots, Carlisle. So how you look at interest rate environment, and how you look at it, the potential impact on that front with Trump 2.0?
Yeah, well, first of all, it's great to be here, Neil. Thank you, and congratulations to the HKMA on a fantastic event. It's an honor to be here. So before I get involved, I want everybody to know Howard and I are friends. And he just gave a very good description of economic history, and I wouldn't debate that with Howard. But what I would say is over that period from 1980 to today, the first part of that decline in interest rates, which he did highlight very explicitly to 2009, I think that was really driven more by monetary policy, globalization, increases in technology, efficiencies in capital markets, and basically everything that drove deflation over that period. From 2009 to today, that excessive period of monetary policy was really in response to 2009. And of course, I think we'll look back on economic history and we'll see that it was really unfortunate that the financial crisis happened in 2009 and the pandemic followed pretty quickly after, because it doubled down on fiscal spending and support, and it also doubled down on monetary policy. And then, of course, we had the reaction we had. I think that in any investing activity, one has to be in a position of micro asset investing. You have to have a value creation plan.
And the way we think about private markets, we're $450 billion at Carlyle today. The largest segment, by the way, is credit and insurance because of the growth in that market. When we think about private markets and when you look at private markets, very little about the evolution of private markets has to do with the decline in interest rates. It has to do with the ecosystem of finance. We didn't have ETFs. You heard on the earlier panel, it used to cost, I don't know what Pong said, $100 to trade a share of stock or several shares of stock. This has been an advancement that's happened from the 90s. I don't think the Wilshire 5000, Howard, you probably know, has had 5,000 names in the Wilshire 5000 in a very long time. We've actually lost half the public companies. That's not because we made a rule that public companies shouldn't exist. Companies figured out that private capital would allow them to grow more efficiently. And so I think private capital has played that role. In terms of interest rates, and I think I'm the first person that's been asked explicitly about Trump, but this is what I'll say. With respect to interest rates, when we look at our portfolio companies, which cover more than 1 million people around the world, the economy generally looks good. It looks particularly good in the US. And the data supports everything you're seeing in the numbers. A year ago today, if I was here, I would have told you we thought based on the KPIs we roll up, we would have seen 2 or 3 interest rate cuts. I think now we actually don't see a number of interest rate cuts. Last year, the market was calling for 6 or 7. We may see a handful next year, depending on how things evolve. But all the policies we know Trump will put in place, lower taxes, more spending, less regulation, those are all pro-growth. And you're seeing it. So I would expect interest rates to stay higher. But the key point I think Howard raised is a market clearing cost of capital is better for everyone.
Great. So, Joe, with this new changing dynamics, right? And we all know that we just cannot rely on multiple expansion to creating return. So what are the playbook for private equity investors, specifically KKR? What are the strategy you're adopting to creating, the good return for the investors?
Well, first, let me thank you, HKMA, for this incredible event. It's great to be back here in Hong Kong. I think Howard said it well. This is about buying well, but more importantly, creating alpha, operational value creation in the companies that you fundamentally buy. I think in our industry, it's a very competitive industry. If you look at this panel here, everyone's constantly trying to evolve and increase their competitive advantage in the marketplace. So how do we do that in private equity? First of all, it's around capabilities. So it's not just about having really smart deal teams. It's about industry specialization, fundamentally. It's about being focused on the right thematics to win long-term tailwinds. It's about creating other parts of your firm's specialized capabilities, government affairs, public policy, especially in a market like this where regulation, tariffs could be an incredible source of risk or opportunity. It's about having operational executives and specialists on your team. We have an in-house consulting firm called Capstone with over 100 executives working with our portfolio companies every single day. We have an in-house capital markets team. When you think there's going to be volatility in the financing markets or access to capital, we have a 100-person capital markets team. In the last 5 years, they've been underwriters or arrangers of over $850 billion of debt and equity transactions. 2/3 of that is for our own portfolio. 1/3 of that is for third-party clients of ours. So you need a lot of different tools to win in today's private equity world.
Great. So to Jim, so we already talked a bit about how the opportunities present themselves to the private equity investors. But given the evolving regulatory changes and potentially macroeconomic disruptions, what do you think about the sector itself, private equity as an industry? What are the structural changes that the industry could actually evolve into?
I'm a student of industries, and actually one of the most interesting industries I'm involved in is our own. So 40 years ago, a few of us got together in these small partnerships to launch something that didn't have a name. It wasn't named until 1997. Today, that is a $6 trillion industry. And the dollars really don't capture it. If you look, just to use US numbers for a moment, about 7% of the US employment base is in private equity. There's 4,800 public companies in the US. There's 30,000 companies, some of the most interesting companies in the private equity market. And the private equity market is the largest client for banks, law firms, consulting firms around the world because it's an industry that remakes itself every 5 years. So interestingly enough, one of the most fascinating investments you could have made in the last 30 years is the private equity industry. But it hasn't been uninterrupted. There have been moments where things have gone to hell, and there was 89, 90, there was 2000, there was 2008, and in those moments, two things happened. The industry themselves changed the structure, and something good came out of it. Out of the 1990 disruption, the private real estate business came out. The software investing business came out of 2000. The private credit business came out of the global financial crisis. So good things happen, but also change happens. We are in one of those moments right now. Fundamental shifts happening. What am I seeing? First of all, the strong are getting stronger. I'm happy to say you can see it in our stock price, but for the first time, I think people are understanding this industry is hard. I went gray at 35. Like it's not hard to make investments, it's hard to make them over 30 years consistently, and places like HKMA need us to do it for 30 years consistently, and that takes a staying power. In this cycle, John, you know this, more dollars have gone to the top firms in this cycle. There's also going to be a shakeout. Bloomberg recently reported that 25% of private equity funds haven't raised money since 2015. It's hard to kill a private equity fund. They stick around for a long period of time, but the industry is remaking itself. And with capital tight in the institutional marketplace, private equity will find new sources. And what's happening is insurance is a form of savings going into private equity and private credit. We're now going to the high net worth channels. So the industry is fundamentally shifting in some funny ways. And there's going to be some problems to solve. The venture capital industry has a huge NAV problem right now. It's only returning 5% on NAV. It's usually 25%. Obviously, we've got to get DPI flowing in our industry. So fascinatingly enough, one of the most interesting sets of opportunities I see are very close to home. And keep an eye on the private equity industry. One thing that people tend to do wrong is this is when they step back from the industry. The industry was declared dead in '89. It was declared dead in 2000. I remember in 2009, my then 12-year-old daughter walked in and said, Daddy, are you okay? I had the Wall Street Journal in front of me, and the headline was, "Private equity is dead meat." That was 2008, before a huge growth in the industry. So this is a moment of time where there will be a change in the industry, but as Joe was saying, the tools of the industry mean that interesting times are also ahead.
Great. So private equity is definitely not dead. Actually, Rob, congratulations to you. We just saw the successful IPO of CVC. So how you look at, the sort of this listing considerations as a private equity manager, and how that listing going to be contribute to your long-term success?
Well, first of all, thank you very much to Eddie, to Howard, and the HKMA team for inviting us all over. It's a privilege to be here. No, thank you. It's exciting times, and I think compared to all my colleagues on the stage here, we of course took a lot longer to take the plunge into the public markets, and so we certainly had plenty of time to give it consideration. I think the key for us was actually ensuring that in going public, we didn't lose the very ingredients that were the source of our success. And I would particularly point to two areas. Firstly, having the delivery of sustainable outperformance for our LPs as our key priority. I think that's always how we've built CVC, and making sure that that absolutely remains the preeminent element of our business is key. The second one actually is about culture, interestingly. Just before David was on earlier on, but I asked one of his very senior colleagues to join us at our offsite over in Athens earlier in the year to talk to us ahead of our IPO about what were the main things that Goldman had found were challenges about being public. And he actually said culture and communication. So I don't know whether my colleagues on the stage here would agree with that, but certainly that and maintaining our culture, because the culture is the glue that holds CVC together. We have our business is based on a huge international network, 30 offices across 5 continents, and making sure that all of those people communicate, they work well, the relationships and the culture that binds everyone together remains. So those were the key considerations, Neil, that we had. In terms of how it is likely, and we hope it contributes to the ongoing success of CVC, well, it's exactly as Jim's just been mentioning. We're seeing huge changes within our marketplace, all of us. And we're seeing huge consolidation, actually. What we are seeing, as Jim's just said, is the strong getting stronger and the weak struggling. And certainly in terms of the largest and most sophisticated LPs, they are consolidating their relationships and their investment across our industry. They are looking to place much larger amounts of capital with fewer GPs, and they are looking at those GPs with whom they have the deepest, broadest, and longest relationships and who have delivered for them for the longest period of time. And so that is a key theme. The other key theme, of course, is consolidation amongst the private markets players. And that's a very, very important part in terms of us all growing and broadening our strategies and our platforms. And so being public, I do really feel, gives us longevity. We're in a very, very long-term business. It's about structure and governance, but it gives us the strength of balance sheet and the strength of brand to allow us to build our business in terms of broadening that platform and participating in that consolidation. And of course, we are all ultimately people businesses, and it allows us to continue to attract and retain the very highest quality people. Those would be the key elements, I think.
Great. And, European private equity has shown some very significant resilience. So in your view, what are the great opportunities that are out there for you? How you read the market, opportunity for European buyout?
Yeah, well, of course, Europe is our heartland, and Europe has, as you say, been remarkably resilient over a very, very extended period in terms of delivering private equity returns. In terms of the dynamics of the market, I think it's the ability in that resilience is very largely linked to the dynamics within the market. And those dynamics are very much about complexity. I mean, it was interesting hearing Jean talking earlier on about the challenges that Europe confronts. Europe is an ever-changing dynamic, and it's very, very hard to predict. And I think that is the essence of Europe. Different countries, different regions are facing different dynamics at any given time. And that is why it creates both complexity, but also it creates a lot of inefficiency in the market. I think certainly compared to the US, the private equity market in Europe is a lot less efficient. And of course, for those of us in strong positions within that market, particularly with local people on the ground in those markets, what that means is that we have an ability to really outperform, and that's the real key to the dynamics within Europe. Having local people on the ground in the local markets, and then also just in terms of looking at opportunities, it was interesting just hearing the discussion just now about what it takes to succeed in Europe. I would add another element in terms of what it takes to succeed, in terms of in addition to just having local people on the ground in the local markets, it's about actually not trying to sit at the top of the organization and predict where and how the opportunities will arise. It's about being bottom up and actually being able to sit at the investment committee at the top and see where the really interesting aspects come through. And that's the key to the future, I'm sure, within Europe.
Thank you. So, today if we talk about private investment, one cannot just go without mentioning private credit. Indeed, this is a hot market, and this seems to be getting to a stage of golden age. And Howard, I just want to like you to share some thoughts on this. Where do you see the those attractive opportunities within that particular sector? At the same time, we have heard last year's panel, this year's early panel, all talk about some regulators have concern about this market grows so big that creating some instability from a regulatory perspective. So what do you think about that? Are you concerned?
Well, obviously, as I mentioned, private credit is a big deal now. It wasn't 20 years ago. And as I think Mark mentioned, a lot of its growth grew out of the failings of the banks or the shrinkage of the banks post-GFC. I think that private credit will continue to grow. And by the way, every meeting I go into, people say, let's talk about private credit. And Mark, I always say, let's talk about credit. We're gonna have both, and maybe Mark's right, we're gonna converge. But I think the important thing to notice about private credit is that it is relatively new in its current size and iteration. And as Buffett would say, the tide hasn't gone out. And the tide will go out someday. And we'll find out who was swimming naked. And we'll find out who made good credit decisions or who did not allow enough margin of safety when they made credit decisions. So there'll be some sorting out, as there always is. And then as Jim says, the best will get bigger. Let me just address for 1 minute, Neil, your question about regulation and risk. My own view is that we're not talking about systemic risks like we saw in the global financial crisis. In the global financial crisis, of course, which was underpinned by subprime mortgages, which had never been tested and which turned out to be entirely fallacious. Number one, we saw the disappearance as independent entities of Merrill Lynch, Bear Stearns, Lehman Brothers, AIG, and several others. I think for two main reasons. Number one, because they were hugely levered, which the private credit industry is not. And number two, because they were interconnected. And in 08, we coined the phrase counterparty risk, which then became a big deal. And, one person's assets was the next person's liabilities, and they could fall like dominoes, and appeared to be in the process of doing so until the process was arrested, I guess we'd say 16 years ago this month. But I don't see that degree of interconnectedness or the degree of leverage. And, if some private credit loans turn out to have been mistakes and some pension funds or sovereign wealth funds lose a little money, I don't think anybody's going to hold the benefit or rush in with a rescue program. So I think that the risks are idiosyncratic, not systemic, and not alarming.
Great. Jim, back to you. So, where do you see those specific sector that you're excited about? We got 2.6 trillion dry powders now raised over the last several years for private equity, venture capital. I know you're spending time and focusing on ESG, new energy. Tell us, what are the sectors that you like to get into?
We're about to prove that it's not about the landing. One of the things that's interesting to me is we have an absolute fascination with landings. When you're flying home, the one time the plane is quiet is when you're about to set down, even though it's safer than when you pull out of your garage. Same thing is true in the financial markets. A great party game is how long you can watch a financial show without someone saying hard landing, soft landing. Always take the under. And having traveled a lot, it's never about the landing the trip. It's where you start and where you end. And I worry that right now in the financial markets, we've had a 4-year debate. I think this is the longest one, Neil, I can ever think of hard landing, soft landing, hard landing, soft landing. But where are we landing? So I'm not a macroeconomics person, so where we're landing is a very different place. I was jet lagged in Mumbai the other day. I thought I woke up in 78.
There were missiles in Gaza, there were tanks in Eastern Europe, there were politicians talking about price controls and tariffs. Like, this is a totally different world. We've assumed margins would go up forever, that markets would be global. We are in a different place, and have you packed for it? Eras are often defined by their business battles. We are going into some of the biggest business battles you've ever seen. Yes, AI is big, but who's going to win? This is battle of the titans. Someone is going to lose. Autos, like, you want to get a country upset, talk about their auto industry. We have EVs, we have ICE engines, we have hybrids, we have self-driving cars. We thought it was going to be about existing companies that were remaking the guts of their cars. We thought it might be about Tesla. It may be about battery companies that are just wrapping their batteries in cars, and those are now at 15% the price of an original Tesla. So what about it when EVs are cheap? Streaming, who's going to win that? Data centers, I agree with you, John, but the profit pools are very unclear. These are going to be fascinating. And what it will take to sort that out is not macroeconomics. It's actually investing skills. And what's on the table? Supply chains are 100% on the table today. For 40 years, we've been making them one way, just in time. Now, all of a sudden, as someone said, just in case, we're bringing them back home. We're going to remake them in a few years. We're remaking our whole IT system on AI. We're remaking our whole energy system. We've done all these things before. We've never done them all at once. Huge capital is going to be needed. Huge investment skills are going to be needed. And then just to kind of give you an investor's perspective on the question you asked, sustainability was an evangelical thing that was taken over by, SASB and GFANS and SBTI, et cetera. It's now quietly become a practical thing. And if you cut through the noise to the signal, it's the cheapest form of energy in 85% of the world. Last year, it was $2 trillion of spending in CapEx. Fossil fuels were $1.5 billion. Yes, policy is going to change, but policy changes in healthcare all the time, and we all invest in that. Most of the policy debate appears to be on the Texas-Oklahoma border. India is not so worried about that. So around the world, this is kind of happening, and how we get behind it as investors is going to be critical. So this idea of, you said it, it's going to be about alpha, but if I'm going to invest in something right now, I'm going to invest in investing skills, because this is an era where your alpha is going to come not from risk on, risk off, but which risk?
Great. So one area in the private investment we haven't touched is real estate. So Harvey, what's your take on the market? Because we have seen some significant repricing of the market over the last 2 years, and there are a lot of changing dynamics. There are headwinds on inflation, there's continued easing coming on the interest rate side, and then there's company asking or demanding their employees going back to office. So what's your take? Do you agree with John's comment early, about the sector?
Yeah, so the headline short answer, because it's always bad to stand the last panel between all of you and lunch, but the headline short answer on real estate is we like it. I think for a lot of people in the world that are not really embedded in the market, particularly in the United States, they think of real estate as, do you like office or not? Because that's what's gotten all the attention. And the real important point, which John talked about, is it's not homogeneous. So we've been in real estate for well over 20 years. We have an extraordinary team. They're actually actively raising capital now, so I can't speak a lot about that. But what I will say is this: when you actually begin to bifurcate the market into its component parts, when you look at office, we are not exactly particularly enthusiastic about office right now, broadly speaking. There are certainly very significant opportunities, but right now, if you look at for example, occupancy rates are running 5-6% above historical averages, even during some stress periods of time, and about $1 trillion to $1.5 trillion of real estate exposure, office space exposure, sits on bank balance sheets. That's not a healthcare Surgeon General's warning about that. That's well understood by the banking system, but it's a very slow-moving iceberg that has to be digested. And so when we think about that, sometimes we think, well, maybe the opportunities are more on the debt side of office, and certainly as it relates to people demanding people coming back to work, when you look at the levels of return, it's not as significant in the U.S. as it is in other parts of the world. And I think we have to assume at this stage, until we get different information, that the demographics of office space have just completely changed for an extended period of time. With respect to the rest of it, one of the things that's happened is interest rates went up, which maybe wasn't as well anticipated by all of us as we should, is the benefit to homeowners. So, for example, take my niece, who's a speech therapist on the East Coast. She locked in her mortgage at 2.7%. That asset, that financial asset for her, looks like a lot of financial assets for a lot of consumers in the United States. That is her best asset, other than when her uncle passes away, which hopefully that doesn't materialize anytime soon. So that's a valuable asset for her. But as rates went up, people were very reluctant to move. And of course, they don't have to move as much now because they can work from home. And so you haven't had the residential creation of housing. And so you do have the shortage that John talked about, multifamily, rental housing, and then demographics, which really are the key here in terms of the shortage of housing, construction because of rates being higher. So there's certainly segments we like, whether it's, warehousing, logistics. I think that's all a very bright spot. And with office, we're super selective.
Thank you. So Joe, back in 2005, you are employee #1 for KKR in Hong Kong or in Asia. Now the firm has expanded to 9 offices in the region. You have close to 70 billion under management here. So how do you see that market be evolved? And moving forward, what are the opportunities in Asia, both as a fundraising sort of destination as well as investment destinations?
So it's actually closer to $80 billion in capital now. But, when I moved here in 2005, it was a very early stage for what we did in private equity, which is large cap buyouts. So we had to adapt our strategy. We were doing a lot of growth investing in addition to buyout transactions. So markets like India, Southeast Asia, China was a lot of growth. And that was a change for our firm. So, probably the 3 things that we had to do differently here. Number 1, we made the decision to really localize heavily from day one. So we have close to 625 people on the ground right now, 9 offices. I have 2 expats on the ground in Asia today. It's all local hires, local executives in each of these offices. The second major decision we had to make was, do we want to raise a regional fund for our different strategies, or do we want to be part of a global fund? And I'm glad we made the harder choice of raising regional funds, first-time funds in this part of the world, because we have more flexibility to allocate capital in this part of the world and actually recruit talent who's super excited to invest in this part of the world. And then third, there are a lot of our peers who are raising country-specific funds or much more narrowly focused funds. We wanted to have a pan-Asian approach from day one. This is a very dynamic part of the world. You need to be able to allocate capital pretty nimbly and flexibly across these different countries. It's not just valuation, but it's macro conditions, it's regulatory conditions. So you're going to flex people and capital into different parts of Asia at different points in the cycle. So, I actually said when we started our business in Asia in 2005 as employee #1, I said at some point in my career at KKR, Asia is going to be as large as the US in private equity. I think that's true. When I look out next 15, 20 years, when you think about China, India, ASEAN, and Japan, compared to the US as a single market, there's no reason Asia can't be as big in private
equity. So when that will be achieved? Another 10 years?
Well, if China would go a little faster, I don't know. No, Japan obviously is the big upside surprise. If you said to me we'd be sitting here in 2024 and outside of the United States, Japan would be the second largest destination for our private equity capital and our real estate investing capital, I bet no one would have made that bet. But it is today. And I said this at our investor day. If you look at our global private equity returns in every single country around the world, our best returns are in Japan in private equity. It's a combination of low valuations, cheap financing, but most importantly, massive, massive operational improvement potential in these companies that we're buying. So, we're still very bullish about this part of the world, and we got a lot of growth ahead of us.
Thanks. Now I'll come down to my last question. In fact, this morning, actually, I asked ChatGPT what are the questions that I should ask in this group of heavyweights. And I've input every single person's name. And, I think we have more or less covered all the questions which GPT suggested. But interestingly, GPT didn't ask me to ask him my last question, which is, what is AI's impact on your business? And I would like to each of you to have a very quick answer to that. And obviously, do you invest in AI in addition to how AI impact your business? Maybe from Joe first. Yeah.
Yeah, so we are not early stage tech investors, right? That's just not what we do in terms of seed or venture. So the classic way people probably think about investing in AI, that's not what we do. We're massive investors in data centers, digital infrastructure, things that are going to be fundamentally driven by AI implementation. I would say based on the other panel we heard today, for us it's really about how do we drive productivity in our companies. We're not looking to AI to say we want a standalone investment in a growth equity bet or a venture bet. We're trying to figure out ways to leverage AI to make our businesses better.
Jim?
Yeah, I'm a little conservative on investing in it because I just remember it was 12 years from the Palm Pilot to the iPhone. Things take a little time, but it's picks and shovels. So at this point, it's going to touch everything, and we're massive investors in clean power through our sustainability, and suddenly AI is all about clean power. Who knew?
Rob?
I would echo the point that Jim made earlier on. I think there are going to be real winners and losers within the AI environment, AI as total. And so, yes, we are very, very interested in AI. We're investing in it heavily, and we are utilizing it across our portfolio. But it is about selecting, certainly in terms of the companies we're investing in, it's looking at the companies that can really benefit from AI, but the ones that actually can be taken out by AI. And really working that question out is going to be key.
Credit investors like us don't have much to do with investing in AI at this time. We do facilities, we have a power infrastructure fund that'll benefit. I'm an old-fashioned investor, and I think real alpha is about thinking of things other people haven't thought of and getting to solutions and what I call second-level thinking. And I'm not convinced yet that a computer can be trained to outthink the other computers, which is what it's going to come down to. So I hope and believe there'll still be room for the people with the best investment insights.
Howie, last one.
Yeah, from our perspective, and this word came up, use cases came up a lot earlier. I think use cases are key. So we think about how can we invest better, how can we make our portfolio companies operate and improve better, and then how can we run the firm better? And maybe I'll just give people two super quick examples. But when rates went up and Silicon Valley Bank went out of business and the Fed was raising rates, we took all of our interest rate hedges for all of our portfolio companies and we ran them through chat. And that's not particularly innovative. But the thing that was interesting, was we said, how do you want to think? We basically said to chat, please run 10 different scenarios. And for me, embarrassingly, because even if I had chat, I wasn't the kid that was going to do that well in school. But the 10 scenarios came back, and so I said to the team, why those scenarios? And they said, see, that's what we don't know. But just assume Chad has read every finance book in the world. But, people like Howard have been running stress tests and analysis, but I bet if those tools existed, which are pretty rudimentary at this stage, you don't have a Silicon Valley Bank because those scenarios easily get run. So you can really do that. The other thing I'll say, just the other end of the spectrum, we took 50 portfolio companies, CEOs and CTOs to OpenAI last spring for 2 days. And at the end of the 2 days, I said to the group, I said, show of hands, who here thinks they've had some sort of light bulb moment in terms of how to innovate in their company that they otherwise didn't know about before they spent 2 days here with Sam and the team and Brad, and 80% of the hands went up. Now, I don't know, we're tracking all those use cases. I don't know how many of those will be real use cases, but even if it's half or 25%, it's material. And I agree with exactly what Rob said. In some cases, these are businesses that will avoid going out of business, and in some cases, they will just get much, much better. But I think underestimating the influence this will have over the next 5 or 10 years, the opportunities are extraordinary, but if you don't manage to it, I think you probably do it at your peril.
Thank you. We are completely running out of time, but I really appreciate all the time, and insight for this group of panelists. Let's give another round of applause. Thank you.
Thank you very much for the insightful panel. Please stay on stage for a quick photo. To the middle. Now to the right, please, here at the media corner. Can we stay for another photo? Oh, please stay for another photo. We'll take another photo here. Thank you. Thank you very much. You may now return to your seats. Thank you. Thank you. Thank you very much. And now we will have a keynote. Okay. Thank you very much to all our distinguished speakers. Please enjoy your lunch, and we will have a keynote speech and fireside chat very shortly. Thank you.